so that you can be able to realize your full potential.
Personality greatly affects your career and how successful you flow in your career. Personality will determine a lot the kind of a person you become. Don't tell me you want to become a lawyer and you don't like speaking, unless you will become a lawyer to assist in research.
You have been given an opportunity, and opportunities comes only once. Not many times it repeats itself in life to change your future.
At the close of the Congress, the scholars expressed their appreciation for the mentorship to remain true to the core.
One of the things that I've learned is what to consider when choosing a career. Like, for example, we have been told about personality. Like, personally, I'm interested in helping others. So I'm really passionate about it, and I want to be a doctor so that I can help others.
I want to become an aeronautical engineer. And I've learned from this Congress that my career, it comes with the capabilities and interests that I have in order to pursue that career. I have all the interests of becoming an aeronautical engineer, and I believe I will.
What I've learned is about factors to consider when choosing my career, and the most important one are personality, interest, and abilities. And right now, whatever I had made my choice to be my career, I have to change because I didn't have an interest in it.
I had many courses, but from my interest and abilities, I have concluded that computer science is fitting into me.
The 2023 Wings to Fly Scholarships cohort has been selected. The 1,000 students were identified after a thorough process that ensured only the bright and most needy scholars who sat the Kenya Certificate of Primary Education exams in 2022 were admitted to the program. The Wings to Fly Scholarship Program is a partnership between Equity Group Foundation and Equity Bank, with additional financial support by the German government through KfW, MasterCard Foundation, USAID, UK-aid, private institutions and individuals.
At Independence, we said we had the three enemies: ignorance, poverty and disease. That's what this foundation is all about. Look at education. Equity has devoted itself to so.
Wings to Fly and Elimu scholars from Central Kenya have been advised to choose their individual purposes and goals in life and chart their route to achieve them. This was said by Equity Group Director of Finance, David Ngata, when he spoke to 1,300 scholars gathered at Baricho Boys High School in Kirinyaga for the event organized by Equity Group Foundation. Ngata told the scholars attending the 2023 Annual Education and Leadership Congress to ensure they do not deviate from the path that would lead them to the fulfillment of their purposes.
A mind is a terrible thing to waste. And that is why Equity Group, Equity Foundation, the government through the Elimu Scholarship has chosen to invest in you based on your performance, stellar performance that you had 3 years ago, 4 years ago for those of you who are in Form 4. You will go nowhere without discipline. So be disciplined, and especially self-discipline. Small things repeated over time make a big difference.
The scholars were urged to be self-disciplined to be safe, adding that they would be rewarded by the power of compounding proportions to become leaders with values in the long run.
In your life as students, you have the whole entire world open to you. Things don't just happen. Things are made to happen. And the person to make things happen in your life, firstly, it's you. The community will come afterwards, your teachers will come afterward, but you have to be persistent.
The Form 3 and 4 students attending the Congress were reminded not to rest on their laurels, as past performance is only an indicator of potential. The Congress was held under the theme, The Power of Purpose, aligning values and leadership, and involved speakers invited to interpret it to the scholars.
It is through the management of the Wings to Fly program that the government of Kenya saw the wise management that it decided also to bring on board Equity Group once more to manage the Elimu scholarship. We want to appreciate and acknowledge the contribution that you've made not only in the business world but also in mentoring our young people, taking care of their needs, academic needs that they would otherwise not have gotten if it were not for your intervention.
You've been given an opportunity by the government of Kenya, by Equity, so that you can be able to realize your full potential.
Personality greatly affects your career and how successful you flow in your career. Personality will determine a lot the kind of a person you become. Don't tell me you want to become a lawyer and you don't like speaking, unless you will become a lawyer to assist in research.
You have been given an opportunity, and opportunities comes only once. Not many times it repeats itself in life to change your future.
At the close of the Congress, the scholars expressed their appreciation for the mentorship to remain true to the cause.
One of the things that I've learned is what to consider when choosing a career. Like, for example, we have been told about personality. Like, personally, I'm interested in helping others. So I'm really passionate about it, and I want to be a doctor so that I can help others.
I want to become an aeronautical engineer. And I've learned from this Congress that my career, it comes with the capabilities and interest that I have in order to pursue that career. I have all the interests of becoming an aeronautical engineer, and I believe I will.
What I've learned is about factors to consider when choosing my career, and the most important one are personality, interest, and abilities. And right now, whatever I had made my choice to be my career, I have to change because I didn't have an interest in it.
I had many courses, but from my interest and abilities, I have concluded that computer science is fitting into me.
The 2023 Wings to Fly Scholarships cohort has been selected. The 1,000 students were identified after a thorough process that ensured only the bright and most needy scholars who sat the Kenya Certificate of Primary Education exams in 2022 were admitted to the program. The Wings to Fly Scholarship Program is a partnership between Equity Group Foundation and Equity Bank, with additional financial support by the German government through KfW, MasterCard Foundation, USAID, UK Aid, private institutions and individuals.
At Independence, we said we had the three enemies: ignorance, poverty, and disease. That's what this foundation is all about. Look at education. Equity has devoted itself to solve this problem to the best of its ability. But it's not solving this problem, but creating leaders who it can partner with in the future to solve these problems.
The initiative to support disadvantaged students pursue education is geared towards positively transforming their lives and their families, but more fundamentally, developing the next generation of transformative leaders.
The poverty index pia wenye wako chini kulingana na makaratasi yale ambayo muliandika tuliyapitia zote.
The scholarship selection process started with public announcements throughout the whole country through religious organizations, local and national radio stations, social media, and local administrators. The applicants, after shortlisting, were then invited for interviews at appointed locations where scholars and their guardians first met the Community Scholarship Selection Board, CSSB members.
Kazi tunafanya hapa ni kazi ya haki na kazi ya ukweli. Hakuna upendeleo. Bank manager hana anything to do with influencing.
These forms are very available. You go to the bank, you find them free of charge. You go to the equity agents, you find them there.
It is almost a 3-kilometer hike up Marini Hill where Michael Kemei and his grandmother, Cheptanit Paulo, are about to receive guests. Members of the West Pokot CSSB have paid them a visit after a successful interview to secure a slot in the 2023 Wings to Fly Scholarship.
I used to live with my father. When my second mother came, he started by not wondering me. So I came to live with my grandmother. I scored 352.
The family has only one hut that they call home.
My grandmother sleep here and me, I will go to look for a place to sleep. There was a time my friends refused to open the door for me to sleep there, and I was forced to sleep outside. I sleep in the bushes.
Cheptanit, or Goko, has not been down this hill in 5 years. A snake bite that has since healed almost took her life. A clerical error of her date of birth on her national identity card renders her too young to access cash transfers for the aged.
The stories we get from these learners, they move us, and we give them per merit. Some of those children who are left out, personally I've taken 2 of them and I'm assisting them in their schooling.
Mitchell Modhoni hails from Matongo village, Muranga. The 14-year-old lives with her single mother who ekes a living from mining sand. Mitchell has never known her father as her parents parted ways when she was still a toddler. Her mother later moved into Mitchell's great-grandmother's home.
Main challenge was school fees. Since my mom sometimes couldn't get a job, so I had to get out of school and come back home, wait until she gets some school fees, then I can go back to school.
Mitchell attended Matongo Primary School, where she sat her KCPE exams to score 416 marks, emerging the third best student in Murang'a County.
I need the Wings to Fly scholarships because I really need to achieve my dreams and also in my studies. And I would also like to help my mom to get out from this poverty. Doesn't mean that you are poor, that you can't achieve your dream.
This is Kakuma, a small northern Kenya town in Turkana County. It is in this area that the sprawling Kakuma refugee camp is located. This camp has been home to Adut Manyok from South Sudan. Adut's aunt fled to Kenya when civil war broke out in her home country in 2013. She tagged along her children and her brother's children, including Adut and her 5 siblings.
Someone who was a family friend told us that if we could move from that place without being killed, then we could be helped being brought to the camp.
The family settled in the camp that supports refugees from different countries.
I started schooling in 2015. I was poor in education, but my friends and neighbors have been telling me that school is good. So I started going with them to school. Together we came home in the evening. Then if there is no food, then we still gather around, all of us, and then we study to read.
Pate Island is a secluded island nestled 25 kilometers east of the bustling Lamu town. It is here, amidst the tranquil waters and sandy beaches, that the Community Scholarship Selection Board members sitting in Lamu set sail to find Isa Faizal's home. The 14-year-old boy has faced unimaginable challenges in life. Abandoned by his father at infancy, Isa and his siblings have had to navigate through life supported by the single mother.
Mimi naishi na mamangu na tuna watoto ni 4. Tangu nilipoinukia mimi sijamuona babangu. Changamoto tunazopitia kuwalisha watoto mama, kwa sababu mamangu anatulea peke yake na tuko watoto 4.
Jamii nyingi sana wafurahia na scholarship ya Equity kwa sababu mbili. Kwanza inawalipia
and a wonderful day that you have given unto us. Thank you for giving us a gift of life and even making it possible for us to gather here this morning for our meeting. I want to bless you for all who have already come and those on the way. We want to pray even as we thank you for the provision of breakfast. I bless it as we take it, and I want to thank you, Lord, even as we plan to start the meeting. We're praying for your presence, for this is our prayer in Jesus' name. Amen. Please enjoy your breakfast.
Here is your mokimo and a fried egg. I think you mixed the orders. I asked for some chips and chicken.
Sorry, madam. In this restaurant, you get what we give you, not what you want.
Oh.
Most loved brands by women in Kenya. Proudly brought to you by BSD Group and Ipsos. And here's the top 5. Number 5. Naivas. Number 4.
Equity Bank. Equity has been voted the most loved bank brand by women in Kenya for the second consecutive year. The bank was ranked 4th overall after Safaricom, M-Pesa and Airtel in the BSD Group Top 100 Most Loved Brands by Women in Kenya consumer market survey carried out by Ipsos. Speaking at the unveiling of the survey, BSD Group CEO Eva Moraya said,
Wings to Fly and Elimu scholars from Central Kenya have been advised to choose their individual purposes and goals in life and chart their route to achieve them. This was said by Equity Group Director of Finance, David Ngata, when he spoke to 1,300 scholars gathered at Baricho Boys High School in Kirinyaga for the event organized by Equity Group Foundation. Ngata told the scholars attending the 2023 Annual Education and Leadership Congress to ensure they do not deviate from the path that would lead them to the fulfillment of their purposes.
A mind is a terrible thing to waste. And that is why Equity Group, Equity Foundation, the government, through the Elimu Scholarship, has chosen to invest in you based on your performance, stellar performance that you had 3 years ago, 4 years ago, for those of you who are in Form 4. You will go nowhere without discipline. So be disciplined, and especially self-discipline. Small things repeated over time make a big difference.
The scholars were urged to be self-disciplined to be safe, adding that they would be rewarded by the power of compounding proportions to become leaders with values in the long run.
In your life as students, you have the whole entire world open to you. Things don't just happen. Things are made to happen. And the person to make things happen in your life, firstly, it's you. The community will come afterwards, your teachers will come afterward, but you have to be persistent.
The Form 3 and 4 students attending the Congress were reminded not to rest on their laurels, as past performance is only an indicator of potential. The Congress was held under the theme, The Power of Purpose, aligning values and leadership, and involved speakers invited to interpret it to the scholars.
It is through the management of the Wings to Fly program that the government of Kenya saw the wise management that it decided also to bring on board Equity Group once more to manage the Elimu Scholarship. We want to appreciate and acknowledge the contribution that you've made, not only in the business world, but also in mentoring our young people, taking care of their needs, academic needs, that they would otherwise not have gotten if it were not for your intervention.
You've been given an opportunity by the government of Kenya, by Equity, so that you can be able to realize your full potential.
Personality greatly affects your career and how successful you flow in your career. Personality will determine a lot the kind of a person you become. Don't tell me you want to become a lawyer and you don't like speaking, unless you will become a lawyer to assist in research.
You have been given an opportunity, and opportunities comes only once. Not many times it repeats itself in life to change your future.
At the close of the Congress, the scholars expressed their appreciation for the mentorship to remain true to the core.
One of the things that I've learned is what to consider when choosing a career. Like, for example, we have been told about personality. Like, personally, I'm interested in helping others. So I'm really passionate about it, and I want to be a doctor so that I can help others.
I want to become an aeronautical engineer. And I've learned from this Congress that my career, it comes with the capabilities and interest that I have in order to pursue that career. I have all the interests of becoming an aeronautical engineer, and I believe I will.
What I've learned is about factors to consider when choosing my career, and the most important one are personality, interest, and abilities. And right now, whatever I had made my choice to be my career, I have to change because I didn't have an interest in it.
I had many courses, but from my interest and abilities, I have concluded that computer science is fitting into me.
The 2023 Wings to Fly Scholarships cohort has been selected. The 1,000 students were identified after a thorough process that ensured only the bright and most needy scholars who sat the Kenya Certificate of Primary Education exams in 2022 were admitted to the program. The Wings to Fly Scholarship Program is a partnership between Equity Group Foundation and Equity Bank, with additional financial support by the German government through KfW, MasterCard Foundation, USAID, UK Aid, private institutions and individuals.
At Independence, we said we had the three enemies: ignorance, poverty and disease. That's what this foundation is all about. Look at education. Equity has devoted itself to solve this problem to the best of its ability. But it's not solving this problem, but creating leaders who it can partner with in the future to solve these problems.
The initiative to support disadvantaged students pursue education is geared towards positively transforming their lives and their families, but more fundamentally, developing the next generation of transformative leaders.
The poverty index pia wenye wako chini kulingana na makaratasi yale ambayo muliandika tuliyapitia zote.
The scholarship selection process started with public announcements throughout the whole country through religious organizations, local and national radio stations, social media, and local administrators. The applicants after shortlisting, were then invited for interviews at appointed locations where scholars and their guardians first met the Community Scholarship Selection Board, CSSB members.
Kazi tunafanya hapa ni kazi ya haki na kazi ya ukweli. Hakuna upendeleo. Bank manager hana anything to do with influencing.
These forms are very available. You go to the bank, you find them free of charge. You go to the equity agents, you find them there.
It is almost a 3-kilometer hike up Marini Hill where Michael Kemei and his grandmother, Cheptanit Paulo, are about to receive guests. Members of the West Pokot CSSB have paid them a visit after a successful interview to secure a slot in the 2023 Wings to Fly scholarship.
I used to live with my father. When my second mother came, he started by not wondering me. So I came to live with my grandmother. I scored 352.
The family has only one hut that they call home.
My grandmother sleep here and me, I will go to look for a place to sleep. There was a time my friends refused to open the door for me to sleep there, and I was forced to sleep outside. I sleep in the bushes.
Cheptanit, or Goko, has not been down this hill in 5 years. A snake bite that has since healed almost took her life. A clerical error of her date of birth on her national identity card renders her too young to access cash transfers for the aged.
The stories we get from these learners, they move us and we give them per merit. Some of those students who are left out, personally I've taken 2 of them and I'm assisting them in their schooling.
Mitchell Modhoni hails from Matongo village, Muranga. The 14-year-old lives with her single mother who ekes a living from mining sand. Mitchell has never known her father as her parents parted ways when she was still a toddler. Her mother later moved into Mitchell's great-grandmother's home.
Main challenge was school fees. Since my mom sometimes couldn't get a job, so I had to get out of school and come back home, wait until she gets some school fees, then I can go back to school.
Mitchell attended Matongo Primary School, where she sat her KCPE exams to score 416 marks, emerging the 3rd best student in Muranga County.
I need the Wings to Fly scholarships because I really need to achieve my dreams and also in my studies. And I would also like to help my mom to get out from this poverty. It doesn't mean that you are poor, that you can't achieve your dream.
This is Kakuma, a small northern Kenya town in Turkana County. It is in this area that the sprawling Kakuma refugee camp is located. This camp has been home to Adut Manyok from South Sudan. Adut's aunt fled to Kenya when civil war broke out in her home country in 2013. She tagged along her children and her brother's children, including Adut and her 5 siblings.
Someone who was a family friend told us that if we could move from that place without being killed, then we could be helped being brought to the camp.
The family settled in the camp that supports refugees from different countries.
I started schooling in 2015. I was poor in education, but my friends and neighbors have been telling me that school is good. So I started going with them to school. Together we came home in the evening. Then if there is no food, then we still gather around, all of us, and then we study to read.
Yana du pan go jala to college. Ega dan chatting ga chalo chana le to school. A chalo. Charan chi school le ko ka re pio. Yana ga ana kwan bela school. Chana kor bekere ko dan kor school bi ni ale bi yene. Yana ga kor school.
Pate Island is a secluded island nestled 25 kilometers east of the bustling Lamu town.
Sure of us, we want to start our Equity Group Holdings Q3 2023 investor briefing. And as we start, I would kindly request you be upstanding for the equity anthem, kindly. Bishop Dr. Charles Kariuki to open for us with a word of prayer. Bishop.
Thank you, Alex. And shall we pray? Our loving Father, we want to thank you this morning and thank you so much for this great and wonderful day that you have given unto us. We also want to thank you for this meeting, our investors briefing. We thank you as we gather this morning. We remember where you have brought us from and your faithfulness all along the journey. Even as we gather this morning, our hearts are full of great gratitude because you have never abandoned us or even forsaken us. You have been with us in good times and in challenging times. And we want to thank you this morning and bless you even for what you have been able to enable us to do as we socially and economically transform the lives and the livelihoods of your people. We do thank you. We know this is a privilege that you have given us by your grace to touch lives. We thank you as we commit this meeting unto your able hands. We pray for your presence. We pray for the presentations and everything that we're going to do, let it be blessed of you. We commit it unto your able hands, for this is our prayer in your holy and precious name. Amen. Alex.
Let's kindly take our seats. Thank you, and we also want to appreciate Bishop for opening for us with a word of prayer. Allow me to invite, for those who are following us online, we are live on our digital platforms, and would kindly request, as we continue with the investor briefing, if you have questions, kindly post them on the channels, whether it's on Zoom or LinkedIn or Facebook. We will respond. And allow me to take this opportunity to invite our team leader, Dr. James Mwangi, to present the Q3 2023 results. Dr. Mwangi.
Thank you very much, Alex, for the extension of invitation this morning to have some time with our investors, analysts, and shareholders as we go through the results of the 9 months of 2023. It's really my pleasure to welcome you this morning and to appreciate your coming because then it helps us really to dialogue and to exchange views. 2023 9 months results are being released against a background of continued macroeconomic turbulence. We are a year into this challenge of a global microeconomic shock where interest rates have climbed to try and manage and mitigate the effect of inflation. This global macroeconomic shock come on the back of COVID-19. Before we could fully recover from COVID-19, we went through the supply shock as a result of Ukraine-Russia, and before we could know that the trigger, whether it was a supply shock, induced global inflation, which was then fueled by many factors, including maybe the end of COVID as we knew it, and of course, response to the stimulus packages that had been administered, particularly in the developing world. Our feeling is that inflation has peaked. We don't expect inflation maybe to go back to where it has been. We have seen it reach 5.6 in the US, and is now down to 2.9, still far above the targeted rate. And so consequently, as we climb down slowly to the targeted 2.9 2026, we think then interest rates will start showing. But as we can see from the curve, we see that the Fed projection is to be a very slow decline in terms of interest rate. It will take time. There are no indication as at yet that the Fed will start cutting interest rates. It may happen maybe somewhere mid next year, September next year. We may be a year away, and then chances it will be a gradual decline of interest rates. So it has peaked, but looks like we remain elevated for some time in terms of interest rates. So the situation will change. It's good to say we have reached the peak, and now there seems to be only one way coming down, both inflation and exchange rate. There are concerns, of course, about the issue of Israel and a potential Middle East crisis, which then may trigger a crisis in the energy sector, and whether that then would get the gains to be reversed through energy inflation. So that is still a debate. The geopolitics concern seems to slightly have been toned down by the recent meeting between the US and China and the agreement to collaborate on military exchange programs, again suggesting that the geopolitical big concerns may have been pushed a bit further. Now, the implications and impact of the global headwinds that we have been talking about, macroeconomic, have been in the domestic market and emerging economies almost the same. Investment in the developed market, US dollar denominated investment became more attractive than domestic investment opportunities. Local currencies significantly weakened vis-a-vis the dollar, and so we have had only one way of outflow of foreign direct investments, and its impact can be seen both at currency level, how the local currencies have depreciated against the US dollar, or the strengthening of the US dollar against local currencies, the impact on demand in stock exchange, and of course the crisis of listed stocks in terms of market caps. Those are all indicators of at the business level. At the individual level, household level, we're still struggling with inflation. The price of commodities, and particularly food, energy, has caused significant constraint to the pockets of the consumer. And of course, governments have not been spared, and governments have turned, those who could borrow have turned to borrowing to fill in the gaps, but those who couldn't borrow have turned into taxation. So broadly, that is the environment in which we have operated. For us at Equity Group, we have compared the current global economic crisis with COVID-19 health pandemic. And we have picked the lessons that we learned during the pandemic, the way we navigated, starting with our customers, rescheduling 45% of our entire loan book to really step in during the steady still of economic activities, giving customers a break on repayment of principal plus interest. And by doing that, really got most of our businesses to bounce back. We kept the lights of the economy on because there was no pressure. We allowed the businesses to repurpose themselves and to adjust to the new norm that had been created, particularly on going online and digitizing their businesses so that people could comply with COVID management protocols while at the same time continuing with their lives. We realized at that time we used our balance sheet to support the customers through those loan rescheduling. But this time, we never know how long inflation will be with us. We don't know how long depreciation of the Kenya shilling will be with us. And we don't know how long the new tax regimes will remain, particularly Finance Bill 2023. As a result, you cannot use the balance sheet to postpone obligations because, as we have seen, inflation and interest rates might be high, maybe for 2 years. As a result, we chose to use the P&L to mitigate the full impact of inflation and the sort of depreciation of the Kenyan currency by ensuring that the impact of interest rates, ensuring that we didn't pass the full price of high interest rates, the full price of inflation, and the full price of depreciation of Kenya shillings to the customers. And so when you look at our balance sheet, you'll see a unique aspect where interest expense is growing much faster than interest income, deliberately done to accommodate and to carry customers for a period maybe of 1 year until they adapt to the new norm. At the same time, you'll also see operating expenses growing much faster than net interest income, again reflecting the use of the P&L to cushion the customers. So if you look at the equity risk-based pricing model, it puts all the interest expense to the customer and it puts the operating costs to the customer. But given the circumstances, the situation we found our customers in, we decided to cushion them to mitigate the adverse effect that would have on their businesses by carrying the better portion of those costs on our P&L. Once it's in the P&L, it may be a one-off because as soon as interest rates normalize, then that, if they don't normalize over time, you can continue to gradually pass that cost to the customer. The same with the inflation. Instead of a sudden increase in interest rates, commissions and fees, we can stagger that maybe over the next 2 years. So broadly, that is how we have managed the situation, and you see that theme of equity leading to its calling, sticking to its true north, that it exists to change lives, to give dignity and to expand opportunities for its customers. So when movements like this come, then equity will remember that while profit is good, it should not be at the expense of livelihoods. It should not be at the expense of preserving and maintaining the micro, small, and medium enterprises, and at a time to support households. In addition to the P&L, you'll see Equity actively using the social engine to capacitate and to de-risk the customers. So very elevated activities of the foundation, particularly on Young Africa Works, were intensive training to ensure we de-risk young people, extensive use of guarantees so that we are able to continue to support customers, and extensive use of partnerships and collaborations with global development partners to cushion the low income through social safety nets. So huge skilled activities, again, because Equity Group is a human story. So essentially we'll also see very significant through that. So that would be broadly the theme, using the P&L to cushion customers, and at the same time using the foundation to mitigate, to de-risk, and to capacitate customers to go on with their lives. So if we then go through the presentation, I will not speak to all the slides, but Equity remain committed to its strategic plan of African Recovery and Resilience Plan. And everything we have talked about is supporting recovery, is using the foundation to make Africa more resilient through capacitation of its people, and the targets have remained the same. By 2030, we hope we'll have delivered on this plan. The flagship projects that so far have been executed speak to significant achievements on our path towards this dream of becoming truly a driver of socio-economic transformation of Africa in a coherent, integrated approach that brings all hearts on the deck, and through partnership and collaboration, delivering for the African people. The business model have not changed. It has remained as inclusive as it has always been. It's a high margin, high volume, low margin, and we have talked a lot about that, and ease and convenience through innovation and digitization has been given priority, while at the same time remaining agile and quality driven. So, and we know the critical success factors of Equity, and the strategy execution has remained, and we follow these throughout. So if we then move to non-funded, we see continuous growth of the group as it becomes very transactional processing, as it becomes more of a trade bank, and hence trade finance and treasury becoming significant contributors to the performance of the group. So again, if you look at this, it tells you that non-funded income can't start on its own. So as it grows 28, we'll also see that loans growing 26%, simply because the group wants to maintain the lights of the economy on. It wants to continue to support its customers. We don't avoid risk, we manage risk. So in spite of the very challenging microeconomic environment, dreams and aspirations of people continue to be fulfilled by supporting them through credit. When we move to the next slide, again, we see that trade finance, as we start to intensely support the African Continental Free Trade Area, as our trade missions to DRC, trade missions to Tanzania, trade missions to Uganda and Rwanda take root, we see trade finance become the product of choice. It's the tool that the group have chosen during these difficult times of balance sheet items, so that we reduce the impact of the headwinds of interest rates on our customers. So quite a lot of use of trade finance. And as a result, we see very significant growth in non-funded income, heavily driven by trade finance and treasury because of the currency conversions as we support cross-border trade. Of course, then treasury must be as efficient as it could, and we have seen the contribution of treasury continuing to become really strong, and the mix of the treasury incomes being less and less on placement, but increasingly on products that support trade finance. We see the impact of the geographical expansion, and we see how significant BCDC have become. If you look at relative to the other subsidiaries and relative to Kenya, DRC is 60% of Kenya, as we have always said. And for that reason, today we have invited the Managing Director of Equity BCDC, Celestin maybe Mkemba. He'll be here so that he can really answer questions that you might have on DRC, and continues to challenge. When you look at performance in terms of assets, again, DRC stands tall compared to Kenya. As we've said, it's nearly 60%. When you look at performance, profit, it is, Alex, you are moving too fast. I think we are on profit, yeah. We see DRC now filling the gap, but we also see Tanzania, Rwanda, and Uganda following that trend significantly. Today we are also with the Managing Director of Tanzania, Isabella. Maybe Isabella could relate. That is a story of significant recovery and a turnaround. So we also brought Isabella, so that Isabella can also answer questions on Tanzania, or share with the investors the opportunities that we are building on in Tanzania. When you look at profit after tax, again, we see significant growth. And you can see the rivalry between Kenya, 22.7 billion and 15.6 billion between the two main subsidiaries. So significant rivalry. And for those who remember what we've gone through, the question, why diversify capital from Kenya to markets with uncertainty? We took a long-term view, but we have been validated. That was the best decision we ever made for this group. Because if you look at DRC, just for a minute, and Alex, we can play back, we see profit growing at 157%, But look at the balance sheet. If you go back a little bit, Alex, one more slide. Yeah, deposits are growing at 28%. If you look at the next slide, Alex, yeah, assets are growing at 31%. Revenues are growing at 81%. As you can see, as DRC becomes more efficient, you can see that it will, hopefully this year, beat Kenya in terms of return on equity and return on asset. So essentially what we had, the beautiful Kenya, it has now been amplified by 60% by DRC. So that long-term view, I hope investors could take note that sometimes it's prudent to take a pause. And we did it at the right time when DRC, Uganda, Rwanda, Tanzania were all funded by Kenya. And now here, the subsidiaries it was funding are outperforming it. And so if we thought the group was getting to maturity, because then Kenya is now close to maturity, it's the entire group has become a startup all over again because of the momentum of DRC, the momentum of Uganda, Rwanda, and the newfound energy that Tanzania brings on the table. So again, to the investors, we can see how the future looks like. That the growth we experienced in Kenya for 30 years, we might be starting another 30 years of growth using these four strong subsidiaries. And when we look at that entire scenario and look at return, let's look at return on assets. The fastest, the highest subsidiary is Rwanda. One would have said Rwanda is a small market, but look at the efficiency. A return on asset of 5%, followed very closely by equity BCDC, DRC, with 3.1, Kenya coming at 2.8, Uganda 2.2, and as we said, Tanzania, the turnaround story. We're very proud of the entire group now. If you average that, we're headed towards 2.93% return on asset for the entire group. When you look at return on equity again, look at the position of BCDC at 28%, beating Kenya at 26%, and Rwanda. And there has always been debate, can you replicate the equity model? As we can see, it has been replicated in all the markets that we operate in. It's a very unique model that allows equity to be number 1 to number 3 in all the markets it operates in, except one. And we can see the cost-income ratio again. And when we look at efficiency, we look at the efficiency of the entire balance sheet. That despite the subsidiaries coming on, when it comes to the entire group, it's as efficient as a unit. And again, that is metrics reporting, that what is being achieved in Kenya is equally being achieved in Rwanda. It's same systems, and so we can deliver very, very efficient. But it's the agility that maybe I may want to look at the balance sheet level. Look at how agile the funding of the bank is. And look at also how agile and how liquid the asset position of the balance sheet is. So we may be going through what we are going through in turbulence, but the balance sheet of the group has been maintained and preserved in a very agile state with extreme flexibility to opportunities that will arise, and as the macro environment changes, as macroeconomic headwinds ease, this balance sheet could be used for whatever opportunities that arise. And that ability gives equity unique responsiveness to the market conditions. Very, very unique. I want to applaud the strategy and leadership team for creating such an agile balance sheet, very flexible and very liquid. As you can see, it's a 50% liquid balance sheet, and you can move with it, and you can mitigate shocks. We mitigate shocks through three big items: capital and capital buffers, which Equity Group is very strong, 600 basis points on capital ratios above minimum. We use liquidity to create buffers. You use quality of assets, but Equity has built a unique capability of an agile entire balance sheet. So it's not just liquid, it's not just light capital, it's not just light asset quality, but strongly looking at the flexibility that the balance sheet offers. As we turn to transactions, we now start seeing what is happening in the lives of the customers. And we can see for the first time a 30% reduction in transactions customers are performing. So if you compare year on year, the transactions of the customers are down about 30%, and that reflects the impact of the headwinds in the lives and livelihoods of our customers. And that is why we have chosen to use our P&L to defend the customers. It's a situation of choosing the customer to profit. And it's simply because that customer has always been with you. This is a temporary shock. You support them, you accommodate them. It is not their will that they will be where they are, but that's the environment they have found themselves in. We feel, given our strength, both at balance sheet and P&L, then we can use for the time being the P&L to ensure that the 35% reduction in transaction of our customers don't impair their businesses, don't impair their lives. We could. But as we can see, as we support them through continued loan growth, we've seen loans are growing at 26%. Then the volume of transactions in the next slide, Alex, continues to grow. The transactions, the number of transactions, because they are livelihood support, may be, but the balance sheets, the strengths of the businesses of the customer continue to grow because we have sustained a credit. We have kept the rights of the economy on at a time when the economy need collaboration and partnership between government and private sector. And when we look at the channels, we look at who is most affected, and we see the low income through digital channels. They're the ones who, and the young ones, they are the ones who are, and this explains why we have used the foundation to reach out to the youth, to provide them livelihood. We have put in 21.4 billion shillings of credit guarantees so that we can continue to fund women, we can continue to fund young people despite the microeconomic environment. We have continued to train women, we have continued to train young people, young entrepreneurs, so that we de risk them because we have seen they are the most affected. If you look at the channel that is affected most is for youth. And as a result of that, we hope we'll be able to mitigate these as we move on. The convenience and ease has been scaled up to 98%. We have become very attractive to young people because of digitization. but we have also delivered unparalleled convenience and ease to our customers because of digitizing both the front end and back end, so that now up to, and we'll see, 58% of the loans, including large loans, can be done through the digital channels. So the volume has not changed as much as the transactions. We continue to see volume maintained. And we see when you go to specific channels, as we have said, the channels that have been affected most are the mobile. You can see the number of transactions reducing significantly, and that is not true of the other channels that are used by stable, strong businesses. And we can see how cashless the country is becoming, how cashless Equity Group is becoming. 82% of all transactions now don't involve cash. And we can see the payment processing, as we have said, transaction processing is becoming a big deal for Equity Bank. The capability of an online business then means we should be strong, including diaspora. Look at how much diaspora remittances were 309 billion. And that then allows this group to be very strong in treasury functions, forex exchange, because as we can see, the diaspora remittances in forex allow us to continue to support the country in terms of flow of foreign currency. And so trade finance enabled quite a lot by the forex flows from the diaspora remittances. And when we look at loans again, we see DRC is again 60% of the loan book of Kenya, consistently growing. We look at the mitigating impact of enterprises in the group, significant retail, significant SMEs, and significant growth in the sectors that represent domestic capital. But because of gain of the size of DLC, we see it's almost a 50-50% between currencies, local currencies and US dollar. They are now almost at the same local currency, 52%, and 47.8 being US dollar as a currency of operation. Again, that has given the group a very huge strength. As local currencies depreciate, the US dollar in terms of translation balances off. And so the effect of depreciation of local currencies is mitigated by the balancing effect of US dollar. So in terms of quality of the loan book, it remains a very strong. We have seen the stress and we have seen our NPLs creep to 12%. We believe we have peaked. We are seeing all the signals of now starting to creep down. We are still 300 basis points below the banking industry in Kenya. That is as at August. I believe the situation might be different in September, a little bit higher for the industry, but that again is what we see is that, and it's clear in on the next slide, 86.4% of that NPL has been provided for, 67.2 has been covered through provisions, very high coverage, and we have also a credit guarantee component of 19%, 21.4 billion that we said would mitigate the small loans that might absorbing both the interest expense interest income difference in our P&L and taking up the cost of inflation through other operating expenses and staff cost have seen a significant growth in our cost income ratio, moving from 47 all the way to 50%. But as we said, this was a conscious effort to support the customers, and we believe that will be compensated. As we have seen, the cost income ratio of DRC have taken another direction, now below 50, and we believe that that will cushion any impact that would be in Kenya. As we said, we have maintained yields, we have maintained net interest margin, as you can see, at 7%. And this, for me, is it was an easy choice to make. Our objective is to change lives, is to give dignity, and to allow businesses to expand. And essentially, we could not be able to pass the interest, the heightened interest. If you look at the US dollar denominated loans, they were at 3%. They are now at 12% because they were LIBOR. But if you passed a 400 basis point increase or a 400% growth in interest expense to the customers, the natural impact will be default. So we chose to use our P&L to accommodate this. And this, for me, is the biggest slide that tells the story of Equity. The bank with a human face, a bank with a human soul. It's not all about profitability. You can choose customers over profitability. You have made profit for many years from those customers. When customers need you most, you start with them. And we are glad that, and you can see it clearly, the cost of funding, how it has moved from 2.5 to 4. That is more than 100% increase. But you can see the yields have remained broadly constant simply because we didn't pass the cost of funding to the customer. And we take a lot of pride in that because when a movement of trial came, we stuck to the true north, start with the customer. The group, as we talked about regional expansion a lot, but the group has also chosen to diversify. And we have gone big in insurance, and in the insurance business seems to be taking ground. We are joined by the managing director of insurance business, Ajara. And again, we want to prompt the investors to the story, the evolving story of insurance. And I think if we move to the next slide, Alex, we can see the position that Equity Insurance has taken in terms of group life. As we can see, it is number 5 in the entire market. And when you look at the market share, we have no doubt by the end of the year, the group will be number 3. And we can see the growth. A live industry, again, a market share of 3. We're seeing that significantly grow. At quarter, we are confident we'll be in the top 5 insurance companies. And we can see the trend because sometimes you need to look at the numbers. If you go to the next slide, and we can see what has been happening to the gross written premiums. The growth and revenue, and insurance is cumulative. So we can see the return premium is lower than it was last year, but when you come to revenue, it is more than double, simply because the policies of last year remains in the book, particularly life process. We can see what is happening to the assets and the size of the insurance business, the lighting up of policies. In just a very short period, we have written up, the next slide, 8.5 million policies. I'm reliably told that is 2.5 times the policies the rest of the industry have been able to light during that period. So our first 12 months have proved to be very strong performance, and the brand tag that we took, the insurance you can trust, I think we have benefited a lot from the trust asset the group has enjoyed. In terms of innovation and technology, we continue to enhance, and we are now seeing, we started digitizing cash, we are now digitizing credit and back office, and we now can see where we are in terms of disbursements and value of disbursements. So technology-enabled solutions seems to work, and they're working across, on the next slide, across all the subsidiaries. So essentially, we see the flagship being Tanzania. That's why we said the transformation taking place is very significant. And now we can see it's not just about number of transactions. We are talking about volume we talked of equity having a human face, having a soul, and we see the work of the foundation. If we move to the next slide, you can see what we have done for the farmers and for young people. And when I was emphasizing that we chose customers of profitability, we can see that yes, the country is celebrating bumper harvests last season, but we can see the role equity has played to make that happen. Young people who choosing agriculture, and we have chosen to make it happen. When you look at providing livelihood, and you can see the steady growth throughout both the COVID period and heavy macroeconomic environment. So if you see our NPLs deteriorating, is because we chose to stick with the customers. We knew there is a lot of uncertainty. We knew it was unpredictable. We never knew when it would end, where it would end, but our calling is to change lives. And it's during difficult times that you are tested whether you remain true to your. We have also stepped up to ensure nobody is left behind. Social protection, and again we have scaled, and as we can see, we have disbursed about 134 billion shillings. We are working with 24 agencies. Salaline, are you in the loop? Yeah, Salaline has really worked very well to ensure that during these difficult times, we have upped the game of getting the UN agencies to increase significantly their social safety net payments. And we can see how much has been disbursed to 5.34 million households. We're talking of huge numbers of households, and that then gives you a feel when you look at it. And if you look at the Wings to Fly kids, with this year's cohort, will top above 60,000 scholarships, and we can see what are the university programs that is producing the equity Afya doctors, the entrepreneurs we are unleashing into the market, what it's doing. You can now see in one slide the number of women, the number of youth who have been trained, the number of farmers who we are using the 21.4 billion guarantee, credit risk sharing guarantee to ensure we maintain. And so that is why we said equity is a human story. And during this time, the foundation has stepped up its contribution in an incredible way. We take pride that, as you can see, by September, over 1.9 million patients had, so we are now talking slightly over 2 million patients. We have been able to see through Equity Afya. Equity Afya is now no longer 89. We have 102 operating medical centers. We are the largest outpatient health franchise, and that's why I said it's not just giving our P&L to support our customers and the public, but is using the foundation to make good. Equity continues to be recognized and celebrated as a global award and accolade-winning brand. This last week, we were celebrating being named the 14th best bank in Africa. The previous year, we had been celebrated as number 22, jumping 8 positions to be in the top 14. We only trust that this year we are working very, very hard to break into the top 10 banks in Africa. And our brand continues to be strong globally, so it's not just in Africa, but globally we are ranked the 4th strongest financial brand. And 4th is quite big. And we still continue to take pride that we are holders of the Oslo Business for Peace Award, that in what we do, we promote peace. The market has not lost sight of what we are doing, and we see the market cap of the bank now has grown significantly, as we said, to almost now be equal to the next 3 banks. The last time we were discussing here, our market cap was about the size of the next 2 largest listed banks. If we look at the numbers, we are now almost the size of the 3 next largest banks. So that takes us then to look at how the balance sheet looks like. And the balance sheet, as we have seen, has become fairly liquid, as we said. Very strong growth, 24% expansion of total assets during a period like this. It's something we really take pride in. But it is the structure of the balance sheet that is the strength of this group. While the size of the balance sheet is big, and we deeply celebrate being a 1.7 trillion shillings, we know from the slide, and Alex, you can take us back to the slide of the market cap, that it is not the balance sheet that counts. If it was the balance sheet that counts, if you added the balance sheets of the other 3 banks, the LIBOR, it will be more than double the size of our balance sheet. But yet, we are. So we have realized there is much more than size. It's the quality. And if you look at our balance sheet, if we go back now to the balance sheet, you see it's the structure of the balance sheet. A very agile balance sheet, a very liquid balance sheet, and a flexible balance sheet. It will be able to respond to the external environment with the speed because of the way it has been structured. A high quality balance sheet. And as you can see, if we take those items that we have seen there, if you look at the asset side, the top three first assets make more than 70%, meaning that broadly cash earning, yielding assets constitute more than 75% of the balance sheet. If you look at the liability side again, you see the concentration. And that, again, penalizes because the funding side, as we said, 72% of the balance sheet of our funding is customers' deposit. Customer deposit talks about the trust, the confidence that we enjoy in the marketplace. But during a time like this, when the government is able to offer 18% on treasury boards, then you are competing with the bank, with the government. And the only way to maintain your deposit base is to match the government in terms of interest you're offering to depositors. And that is where, literally. Then for foreign denominated assets, you are competing with the US. If the US is offering 7, unless you offer 14, as we see in the Eurobond yields, nobody looks at you. You'll have one way. So our liability side has really significantly priced because the funding is predominantly customer deposits. So we're talking about customer deposits is 72%. But if you look then beyond that, long-term debt is another 13%. And that 13% we said it repriced 4 times from 3 to 12 because it was LIBOR, and LIBOR moved from 0.25 all the way to 7, 6. So if you add 7% to the 3, you are already at 10. So essentially, that's how that balance sheet, and that's what we said, we'll not pass that cost to the customers, we'll take it through the P&L, we'll cushion the customers through the P&L, and hence the term, we have chosen the customer to profitability. But we know, like we did with the COVID, we supported them for 2 years. This time, as we have seen, the microeconomic environment has started to ease globally. We believe it will ease in due time, and so if we use this, we'll use it for a year or 2, but we'll remain with the customers for the rest of their lives, like it demonstrated, and we can see the policy. So that really explains the issue. When you look at the P&L then, we see, as we were saying, interest income grows at 32%. But look at interest expense. It grows at 58%, lowering net interest income to only 21%. But strategically, because of promoting African Continental Free Trade Area, we grow trade finance and Forex by 38%, giving us a total income growth of 28%. But again, look at the growth in staff cost, both and other operating expenses. Because of the Kenya shilling depreciating, because of inflation, because of high interests that businesses are passing to the consumer, our operating expenses grow by an average of 47%. And given that we have chosen deliberately and consciously to continue to lead in uncertain times, then we must also be willing to pay the price. And as you can see, we have put up our loan loss provision up by 107. Just to make sure that we don't weaken the quality of our asset book. We cushion the balance sheet by taking it through the P&L. So P&L has two hits. One, recognizing the risk, and the second one of absorbing the cost that would have been handed over to the shareholders. Pay a slight price because of the P&L, and return on average equity starts at 25.1, and return on average starts at 3.1. The financial ratios look solid. Capital, as we said, strong. Yields, steady. Ratios, comfortable. And so this gives us a test, a deep dive on the business. And we see the business fundamentals are very, very solid. The buffers of liquidity at 49, the buffers of capital 600 basis points above minimum, the buffers of yields, the buffers of coverage. That gives us confidence that as we step into the future, the bank is on solid ground. And that then gives us the confidence to do an outlook and a projection into the future. And we said the balance sheet is very, very solid. As we can see, we have not changed our forecast or prediction as to how the future looks like in terms of growth. The actual is right in the middle, so we are not changing that. The interest margins, we have said, we have realized we are not able to pass the entire cost, so we have amended and revised our guidance on net interest margin, non-funded income mix. We have enhanced our expectation on non-funded income. We have toned down our expectation marginally on net interest margin, and we have upped the cost-income ratio. Return on equity, that has slightly been affected. Return on asset, cost of risk, and NPLs, but subsidiary contribution remains the same, and we have increased the subsidiaries' contribution on profitability, giving a story that it's not the entire operating region that is being affected. And what we be losing in Kenya, because it's the most globally interconnected, where the Kenya shillings have depreciated most, that is being compensated by the other subsidiaries, and they're able to contribute 50% of the profit. That really is a summary of our investor briefing and outlook, heavy discussion on the macro, how we start on balance sheet, on strategy, on P&L, and our choice to choose a customer survival to temporary profit. We have taken, like we did when we allocated capital to the subsidiaries, we have taken a long-term view. And the long-term view is support the customer to survive. They remain loyal, they remain new, and stick to your brand as a compassionate brand that starts with its customer. Brent, is there anything I could have added in the big story?
Yeah, thank you, James, and good morning, everyone, and good day to those online. So maybe just to further complement what James has said and maybe just augment some of the comments. So as James mentioned, our Q3 results was against a backdrop of global inflation continuing to decline, but at the same time, global monetary response has started to peak. And the expectations for next year is that global interest rates will start coming down, particularly as we go into the second half of the year. Our markets where Equity Group operates, particularly in Kenya, is no different. Inflation has started to come down. There has been some pressure on the back of energy prices, but for most part, inflation is within the central bank target range, or at least below the 7.5% upper band. So the response, monetary response, has also been to accelerate monetary tightening on the back of these global inflationary pressures. We expect monetary policy to peak with a lag relative to where global monetary responses. So over the next 2 to 3 months, we expect central bank to somewhat a peak in their monetary response. So in addition, in our markets, there has been somewhat of also fiscal constraint. The expenditures, revenue collections has been somewhat constrained, and we see that reflected in our operating environment, and you can see that reflected in the performance of asset quality in our markets like in Kenya. So against this backdrop, Equity Group results, as James highlighted, reflects that of diversification as well as expanding returns on our high growth markets. So to speak on diversification, capital allocation of the last few years has gone towards markets like DRC, Uganda, and more recently as we complete Rwanda as well. Importantly, in these markets, you've seen continued growth of the top line, but also importantly, you've seen these markets expand their ROEs, and we'll point you to the performance of our DRC subsidiary headed up by Celestin. So what you see is in this diversification and ROE expansion, particularly in our high growth markets, is a level of resilience as a group that compensates for what is a challenging environment in Kenya. So those are maybe just some additional comments, James. Thank you.
Thank you very much, Brent. Mary, from financial reporting, anything else you want to add?
I think just to augment on Kenya and how important it was for us to keep supporting our customers, even on the backdrop of the macroeconomic environment. We've made a point to highlight on the emerging business lines even within our investor presentation. So if you look at the work we've done on digital lending, year on year we have grown 90% from about 120 billion in disbursements to 214 billion. Now, the average ticket size of those loans is about 45,000 shillings. That just shows you this is not the consumer type lending, but it's Equity actually showing up for their customers to give them working capital finance. While Kenyans are going through a difficult period, it was important for us to keep showing that support, to keep their businesses running, to keep their businesses going, and we developed that business line to be able to do that, and for them to be able to do it conveniently and 100% digitally at the convenience of their businesses. That line of business is operating at 96% repayment rate, which is one of the best in the markets. So while we are having a problem on the asset quality on the longer term loans, these shorter term working capital loans are still coming through to help Kenyans, and they're able to repay those loans. So just to show that that line, and with that revampment, we are able to support insurance as well, because each and every one of those disbursements is backed by an insurance policy. So the insurance business is able to provide 890,000 insurance policies in 1 year, unique customers. So it's a very intertwined business, whereas yes, there is a difficult environment, we are able to back it up and support our customers with also short-term working capital loans. Thank you.
And I think there comes a very strong proposition that, and maybe Mary, you could have shared the exact data and how we are ranked in the marketplace. I shared the market cap and where Equity is ranked. How do we rank in digital lending?
Thank you, James. We are currently second in market. This is an initiative we only launched in 2021 with the oncoming of the Africa Recovery and Resilience Plan. In that plan, we would like to lend to 30 million unique customers. This is 5 million borrowing businesses and 25 million borrowing consumers. On that backdrop, there was no way we were going to do that with a brick and mortar proposition, which is the branch sort of lending, and we needed to revamp our digital proposition. With that, we launched what we have, our own internal credit scoring engine. We revamped our internal products. We retrained our staff to be able to develop these products, build them internally. And with that, we've been able to grow from, in 2021, we had about 300,000 unique customers to now slightly over 1 million unique customers. We've been able to grow our disbursements to 214 billion. If you look at industry numbers, as at half year, these are public numbers. We are only second to Safaricom Fuliza. We have one of the best repayment rates in the market. We are at 98% on SMEs, 96% on consumers. I think the best rate compared to that would be, again, the Safaricom products, which have 96, but some do have below 70% repayment rate. So with that proposition, we're able to give value, volume, but we're also able to deliver quality to our investors as well.
So ideally, for clarity, we are bigger than any fintech in digital lending. We are bigger than any bank in digital lending, and we are the best in repayments. And more importantly, we are the most affordable because we use bank rates. So we may be as low as 4 times cheaper than some actors in the market, meaning just as the market gets to know, we shall crowd in that entire lending, and that's how Mary says we should be able to achieve our 35 million individual borrowers out of the 100 million customers. So it's a growth lend. We have got it right in repayment. We have got it right in ease and convenience of borrowing, and we have got it easy and convenient. Our average loan is about how many times bigger than industry average?
If you compare that to the largest lender currently, we are comparing 250 shillings against 45,000 shillings.
So it's a different game ball. You're talking about you are comparing less than 1,000 with 45,000 average loan. So we're not letting people to do betting. We are not letting people to consumption. We are letting people to do businesses. And that's why I said it's convenience in lending. And that's what explains why. But also, Mary has just also explained that the digital lending, there we have no challenge because they are being disbursed as we move. The existing loans are where we have seen strain. And this time, unlike COVID, when loans were rescheduled, there is no rescheduling. So any loan that has a strain is coming straight to the NPLs, and that explains the 2 percentage points. They truly reflect the macroeconomic environment, but the good thing, they are secured and they are fully provided for up to 67%, and there is an additional 14%, 14.6% guarantee cover. So we don't see that affecting future profitability in any way. As I said, today we brought you the managing director of Equity BCDC. Maybe Celesta, where are we? I had promised the investors that by 2030, Equity BCDC will be bigger than Equity Bank Kenya. What is your take there? DRC is home to 40% of all global strategic minerals, that the world will need to change the climate conversations to non-emitting energy sources. DRC holds 82 million hectares of arable land that has not been used. DRC holds the largest part of the global lungs in terms of the Congo forest basin. And DRC is having elections on 20th of December. Maybe take us 10, 15 minutes to take us through or speak to some of these issues and the future of DRC as you see it. And the global interest. I heard Americans are funding the longest railway line in Africa, 1,700 kilometers. Is it Lobito corridor? Talk to us about, and Tanzania is busy connecting Lubumbashi to Dar es Salaam using the railway line. What is the story? What are all these activities about?
Yeah, thank you, Dr. James, for the floor, and thank you, dear investors. I would like to appreciate the fact that Equity Group Holding has taken a long-term view about the DRC. And of course, that is really playing out very clearly in our strategy, and as we could see the DRC coming up and Equity BCDC coming up. First of all, the macroeconomics indicators speak strongly about the DRC, coming from 1.7% GDP growth in 2020. The DRC have reached 8.9% GDP growth, so that's really steep growth. And IMF projection is stipulating that in the coming 3 years, even 5 years, we'll still continue sustaining above 6% GDP growth. These growth are actually driven by what Dr. James have just spoken right now. It's about the endowment of minerals of the DRC, which hold 70% of the world reserve of cobalt, copper. We have the treaties and gold. And there are strategic plan from the government to start capturing value addition locally with few initiatives, as we could see, the initiative of building some batteries locally together with Zambia. So there is an agreement which was supported by a free trade area on Zambia and DRC border to start getting the value addition, which will actually triple the value of what is being exported. And as well as Dr. James said, that all the minerals for the energy transformation transition are really in the DRC. And there is a lot of initiative as well to start bringing those minerals through the Lobito port, because the Lobito port is the shortest way of exporting minerals through Angola, which is supported by the US government. The financing have been secure, and the plan is being rolled out. So that will create a lot of efficiency. Instead of mineral being exported through up to South Africa, it will go to the shortest way. So there is a lot of initiative as well on the forest, Congo forest, capturing carbon emission, which is sequestrating carbon. So the Congo forest is the second length of the universe. So basically, we are really supporting the economy. There have been a lot of things going on in DRC, including rating agencies. All the rating agencies have upgraded the country rating in the last 2 years. I think we are at today B+ or BB, so which is, I mean, the investment grading, which have actually unleashed a lot of opportunity in the DRC. being a lot of many investors coming. We have seen 5 hotels being open, like Hilton or bigger names like Marriott coming. So these are really new things emerging in the DRC. There is a strong support from the Bretton Woods institutions, IMF. The DRC have entered to the program. It was successfully launched and successfully validated different steps up to the validation of the 5th review. So we'll be going to the 6th review. This will be the first time that the DRC with the Bretton Woods have reached such a level of reviews. So, that speaks about really the prospect of DRC, which is now in all the big forums worldwide to speak about its case, because as an author have said, that the African continent is like a gun where the trigger is in DRC. Indeed, DRC would carry its weight and will be able to really support in big way the development of Africa, and will play a role in our resilience and recovery plan for Africa. Another major step, so there will be an election, but this is what I could say, it's a consolidation of the democracy. So the democracy is being consolidated through years, since the 2000s. I mean, there have been several elections happening, and this one is as well one of the proof that the constitution is now respected. It will be done in due time. It's an inclusive one where we have 26 candidates being competing for the big seat, and more than 100,000 for the parliamentary roles and others. So that shows quite a vibrant democracy. And from yesterday, the campaign have been launched for only 1 month. So there is no disruption. So 1 month to be dedicated and concluding on that. So I think in a nutshell, this is how I could give a bit of large spectrum about what DRC stand to play. And I really would like maybe to conclude by saying there is a strong support of the group to really, with all the leadership being involved. Actually, we have spent a week together with all the leadership of the group to support DRC and to make it a place of excellence for the group. Thank you very much, Dr. James.
When we invested first in DRC 2016, DRC was ranked number 36 in terms of size of economy in Africa. This year, DRC has moved all the way to be the 10th top largest economy in Africa. Where do you see DRC in the next 10 years?
Yeah, in the next 10 years, I think there is a broader consensus that we will be among the top 3 or top 4 economy in Africa. So it depends on really how these reforms are playing off, and we can really compete seriously on the top 3.
Yeah, the regional largest economies are south, it's South Africa; east, it has been Kenya; north, it has been Egypt; west, Nigeria; and the tip of northwest has been Morocco. It looks like a new giant is emerging in Central Africa, and that happens to be DRC. If DRC will be in the top 4 economies in 10 years, I trust Kenya will be in the top 5. It looks like we will be behind the DRC, but it means we'll be operating in 2 of Africa's major economies. So one would see the trajectory that we are working towards, the planning of the organization. But we have been talking about banking. I said there is a possibility the equity insurance group might be bigger than the banking group. And I was asked, James, how can that be? Banking is intermediation. It takes from those who have and gives to those who don't have. But those who have keep on, their balance keeps on oscillating. When you talk about your pension, it's cumulative growth for life. When you talk about life policies, it's about an entire, when you talk about health, it's a life journey. And it's on that basis that we think our insurance business can be very big. Maybe I will ask Ajara to jump in and paint the picture of where we are in insurance, and because you share my sentiments, why we strongly feel the future is in insurance business.
Thank you, Dr. James, and good morning, everyone. So I think it's an interesting point when we talk about insurance, because we know that the insurance industry has had a low level of penetration, 2.37% in Kenya, an average of 1.3% in the markets we operate, including DRC. And when Equity Group made the decision to go into insurance, over and above the growth and the assets and the profit, it was really about completing the financial protection mechanism for any individual. As you've noted from the presentations from my colleagues, the bank through credit largely enables customers to create wealth, but largely the insurance group would go the next mile to then assist customers to protect that wealth, protect their health, as well as protect their life. Now, in the last 1 year, we've made our foray into the insurance industry. I think the numbers were shared earlier by Dr. James. You can see it's a strong initial start, currently having distributed over 8.4 million policies, which is 2.4 million multiple of what's distributed in the industry. And that really shows you an indication of the confidence that the customers of Equity have in the Equity brand. We also have been able to show profitability sitting at close to 400 million, and as we currently speak, have an asset base of close to 8 billion Kenya shillings for just one initial insurance business. Currently, we're operating a life insurance business, and the life insurance business is currently in the market for 4 products. Now, we're able to show this strong performance from 4, only distributing four solutions, because we've taken a lot of time in the last 1 year to really focus on what our customers want. A lot of you will know that when you look at the experiences you've had with insurance products or insurance providers, there's been a large level of disappointment. Our customers have been telling us that it will take them some time to buy a product, either because the design was not appropriate, or the channel was not good, or it could also be that there are certain conditions in the policy that don't work for the customer. We've taken a lot of time to understand what the customer pain points are, and I can say that we have been bold around product design. We've been bold around certain products such as funeral expense that have no exclusions, and we can already see from the design of the policies. Currently, for instance, our funeral policy is the largest in the industry. We've been able to distribute over 2 million last expense policies. So we're currently in the market, and we're taking the journey to take insurance to the next level, as Dr. James said, and we've seen already quite a large level of uptake. Now, just going back a little bit into the conversation on pensions, we've realized, and if you look at the markets for the last 2 years, a lot of investments in pensions have suffered. Average investment returns of segregated funds is sitting between 0% or -1 and 2%. You can imagine if you have been saving in a pension fund for 20 to 30 years, and at the point of retirement, the level of return is quite low. So Equity Group has made a commitment, has all the technical support and the specialists to ensure that we can then provide our customers and our members with long-term savings. Just As at 30th June of 2023, for 6 months alone, our investment returns on our pension portfolio was 12.6%. If you compare that with the market sitting at about 1.2%. So we've been able to demonstrate that we can do it differently, not because we are chasing a return, but because we understand about being consistent and having a methodology for investments. Currently, we have a push, particularly in the Kenyan market, around Tier 2 investments. This is out of the NSSF, and a lot of customers are now having to go into saving for pension funds. We are available as a partner to partner with all pension funds, to partner with all institutions that now have to make mandatory contributions of up to 6% for their employees and 6% each employee on their own, and invest this over the long term for them to get a return. We do believe that we'll be able to support the economy to grow and enable our members to reach there in good time. At the end of this year, we do expect, this will be 15 months, we do expect that the pension funds that will be investing will cross over 5 billion Kenya shillings. Again, this is a demonstration of the confidence that the customers have in terms of our investment capability. I would also want to highlight our general insurance business. Earlier this year, we came to the market having received an in-principle approval from the Insurance Regulatory Authority to conduct general insurance business. General insurance business focuses on health as well as assets protection. For our health business, we do believe, as Dr. James says, one of the critical things about managing a partnership is ensuring that our customers get there on time. Last year, we disclosed to you that over 40% of the defaults that occur on the bank side or on the credit portfolio happen because of a health incident or a life incident, which means that while we can provide credit, the bank may provide credit, if we do not go the next mile and provide health insurance, then we've not been able to secure our customers' well-being completely. Now, we believe that with the acquisition of the full general license and the health, particularly health license, and our partnership with Equity Afya, as Dr. James said, it is possible for us to be able to provide both affordable and quality healthcare. Equity Afya, as Dr. James said, is currently sitting at 102 clinics. It is the largest outpatient provider for primary care. And what we're saying is that we will not provide an insurance policy if we cannot ensure that the value chain can then support delivery of value to the customer. Equity Afya's presence in Kenya is quite visible right now. Well-trained doctors. Equity Afya is providing affordable and quality services at 40% of the cost of a typical provider. That gives us the confidence that we can then distribute in a very large way health insurance policies that are affordable and that can fit within the wallet of each and every Kenyan. We also have an opportunity to extend this partnership to other countries, as well as DRC, where Equity Afya is now setting up, and also we have unique arrangements around health insurance and life insurance. So in recap, why is the insurance group, in our view, an exciting foray? The insurance group, particularly through life and pensions, will provide longer-term capital. This longer-term capital will diversify the portfolio of Equity Bank and enable us not only to have short-term value, but also to have long-term value. The insurance group, we believe, will be able to significantly impact in terms of penetration. As far as our estimations goes, we believe we should be able to double penetration in the markets in which we operate within a period of 5 years to ensure that this number significantly shifts forward. So we would want to invite our customers and our members to take up insurance with us. We've been able to guarantee you that we can provide quality, we can provide scale, and over and above that, we're able to do so efficiently. Currently, our first insurance subsidiary is operating at average costs to premium of 11%, which is a fraction of the industry's cost of 18 to 22%. So we're not just growing a large business, but we're growing an efficient business so that then value can be created for the customer and value can also be created for our shareholders.
Thank you very much. That will be a good highlight on insurance. The future of the world seems to be on debate. We've always said the current global political governance social structure was set by the Second World War, when Bretton Woods institutions, UN, NATO, and all the trade agreements were signed. We see as if the world is being reset, but this time it's being reset by climate change. And we have chosen to take a conscious, deliberate step to provide leadership so that if the world is being reset, we must place Africa. We have in the right position. We've also seen Kenya take a very bold step, taking the lead and providing direction and adding the voice of Africa on climate action, but extended this to the opportunity Africa has in terms of green industrialization. And this has won His Excellency President Dr. Ruto recognition among the top 100 thought leaders and most influential people on earth by the Times magazine. Given that we have taken a very bold step, I would ask Reshma maybe to take the podium and speak a little bit the role we have focused and the why.
I hope that's better. Good morning, everyone. So as James has said, we're taking a real leadership role in this area. The reason for that is I don't think it's discretionary anymore. Where we are on climate, where we are on the environment, as well as where we are on nature, is all converging. And we're seeing that what we're doing as corporates and what's affecting us as individuals is all coming together. And unless we take that leadership role, it's going to affect everyone. So a number of things that we've been working on. We've been really enhancing in terms of our risk management procedures. Last time I talked about incorporating climate risk in our last update. We're now looking at nature as well. And the whole purpose of that is to be able to assist our clients to be able to understand the environmental and social risks and how we can assist them. But beyond that, the governments are taking a key role in this, as we've seen as the leadership from the Kenyan government and particularly His Excellency Dr. William Ruto in leading this and being a global leader. He's putting together a team to work on this in which equity is going to play a key role in that. But the reason we're there is because we also took a key role during the Africa Climate Summit to say that the private sector has to come together to the table to deliver on this. And we led the initiative of getting the private sector statement written and actually read out at the closing. Because of that as well, we're also, and Celesta mentioned the importance of the DRC in nature. We have taken a position to be an early adopter on the Task Force for Nature-related financial disclosure, and we're particularly looking at the key sectors we're operating in, like agriculture, like mining, and what we can do around conservation and that, what we're doing around carbon credits. And we're working with the government in the DRC on that as well. But in more than that, beyond that, we're looking at what facilities can we bring to the table. We, in October, had the approval from the Green Climate Fund for the largest private sector facility for smallholder farmers, particularly focused on climate adaptation for 4 countries in our region. And that is going to be Equity being the sole executing entity for that facility. But not just the money that we're looking at. We're also looking at what kind of supporting guarantees come with that, but also what kind of capacity building can we create that allows our clients to really understand how climate affects them and how we can work together in developing that. We're also building our teams across the region so that we have the expertise in-house and we can share that with the people that we work with. I think those are what we're working on. In addition to that, we're also part of a number of global thought leadership institutions and initiatives, so that we're not just driving what's happening in the region, we're also driving what's happening globally that affects us in the region as well. James, maybe I leave it there.
Thank you very much. So, climate change will define the world together with the thought of deglobalization, and we feel Africa having 60% of the potential of clean energy, whether it's wind, geothermal, hydro, will play a very significant role as an investment opportunity, investment destination for clean energy. When you look at the strategic green minerals that support technologies of clean energy devices, whether it's batteries and others, again, Africa will play a very pivotal role. When you look at global food security, with 65% of unauthorized arable land in Africa, will play a very significant role. But that must be done in a way that Africa doesn't industrialize and pollute the environment. So sustainability is key. But we can't talk much as a bank. We know banking is about risk management. Allow us to close our presentation by inviting our Chief Enterprise Risk Officer to make a few comments on the risk status of the world, of the region, and maybe of the bank or group. Sam Kitwekere.
Thank you, James, and good morning. Over the last few months, and indeed for most of the year, we have seen financial risks elevate significantly. But I think the way I want to pitch it is to highlight the resilience of the group in the face of the significant financial risks that we have seen that have been triggered and driven significantly by country risk factors. So we are aware of the macroeconomic challenges that the CEO has spoken to, the significant rise in interest rates as a result of inflation in the earlier part of the year, the significant movement, depreciation of local currencies against the dollar. However, the group strategy has delivered on this front. The group strategy to diversify its operations. So whilst the risks have been concentrated in Kenya, we have seen the offset coming from the other subsidiaries, and the CEO spoke to that and highlighted the numbers. We had 50, 51, 54, so Kenya being at about 50% of assets, of revenues, of profits, the rest coming from the subsidiaries. So very strong benefit coming from diversification, geographic diversification, as the other subsidiaries across the other countries have been able to offset the stress that we have seen in Kenya. This stress has also been seen on the liquidity front. So I've moved from the country risk situation to liquidity risk, the second one. And in liquidity risk, the CEO indicated that we have liquidity, our liquidity ratio stands at just under 50%, 49.7%, so very strong. Within that, we have cash and cash equivalents of 262 billion shillings. So a very strong and liquid balance sheet that positions us to take advantage of opportunities should they arise in future, but provides strong liquidity buffers. Moving to credit, the factors that we spoke about, country risk factors, interest rates, inflation, have put a lot of pressure on our customers. But again, we benefit from the diversification of our portfolios by geography, customers in different countries, but also by industry sector, customers across different sectors of the economies in the different countries, also by product and by segment. I want to emphasize, much as we see our NPLs going up to about 12%, 78% of the portfolio of the group sits in the stage 1 performing book. 78% of the portfolio continues to perform very strongly. This number has been consistent and growing marginally over time from last year, in fact, from the COVID period to this point. So the group remains very resilient from a credit portfolio standpoint, even as we see our NPLs ticking up a little bit. Moving to, and we've also heard about the provision cover strengthening significantly, standing at 86.4. Moving to non-financial risks, they remain significant, but have been sort of ebbed by the financial risks at this point. We continue to pay a lot of attention in that space, especially to cybersecurity risk. We're investing significantly in risk management systems to measure and to monitor risk and to provide defenses also in the area of cybersecurity risk. So to wrap up, I would say two things. The group remains very resilient. The resilience derives from the diversification of the group across geographies and other parameters. And also the resilience derives from the very strong buffers that the group enjoys across credit, liquidity, and capital. So thank you very much, James.
Thank you very much, Sam. As we open the floor for questions, maybe let me recap without presentation that these third quarter results are coming at the back of very strong macroeconomic challenges that only compares but adversely to COVID-19 health pandemic. And the bank has borrowed a lot from how it managed, or the group has borrowed a lot from how it managed the global health pandemic to navigate, to wade, and to manage the turbulence that has come with very strong microeconomic headwinds of high inflation, high interest rates, and devaluing our emerging market currencies. And the biggest lesson we learned from managing COVID was that if you protect the customers, you protect your balance sheet. And Equity opted to shield the customers from the adverse effect of very high inflation, high interest rates, and high devaluation of local currencies by ensuring it didn't pass those costs to its customers. So the net interest margin remained the same, the yields on our loan book remained the same, and at the same level like government securities. As a result, our net interest income was impaired by interest expense growing at 58%, while interest income grew at 32%. At the same time, the group focused on keeping the yields on loans flat at 12.1%, while the cost of funding had gone up by 35%. But also, despite the uncertainty, despite the challenges, continued to support the customers and grew its loan book with 26%, while supporting customers using the foundation to ensure nobody is left behind, supporting 5.4 million households with social payments, supporting young people and women with financial literacy, and using guarantees to lend to those who don't have securities to the tune of 21.4 billion shillings. So this is results that reflect a bank with a human heart, a human soul, that chose to defend customers at the expense of profitability. The balance sheet of the bank remained very solid, very agile, because we used the P&L to shield the customers. But in return, the market supported us in two aspects: continued to increase our funding, growing our deposit by 20%, and at the same time pricing us very well in terms of market, leading to market cap. The balance sheet of the group expanded by 24% to reach 1.7 trillion shillings, and a market cap of 134 billion, being nearly higher market cap than the market cap of the next three banks. And broadly, the balance sheet of the bank, as we said, has now been split 50-50 between Kenya and the other subsidiaries. And we also see non-funded income reaching 44%, heavily driven by trade finance, transaction processing, and foreign exchange. We also saw very significant uptake of digital lending, and the bulk of our loan book, 95% by number and 46 by value, is now being processed through digital channels. And digital loans are growing much faster than our loan. The macroeconomic environment has challenged a couple of borrowers, and we have seen our NPLs go up by 200 basis points. But this is the secured loan book and has a very good coverage of 67% in terms of provisions, and a coverage of an additional 14% through guarantees. The balance sheet of the bank remains agile and flexible, and as the environment changes, our Equity Group is very well positioned to respond, to recover quickly as the customers become ready. With that, let's go to questions. Maybe we could I can see George, give George a mic. Anybody else with a question? And as George prepare, let's ask some questions by Divis Githinji, who is on YouTube. And 4 of them have been directed to DRC, so I will ask the MD of DRC to answer them. The first question is he is seeing an increase of 71% in DRC loan book. Could the Equity BCDC MD highlight what the percentage split is between loans issued in dollars and Congolese francs? Number 2, also, are loans in Equity BCDC largely corporate or SME clients? What percentage growth could DRC loan book have had on a constant currency basis? 3 questions.
Yeah, thank you, David, for the question. So first of all, I would like to confirm, that this loan increase of 71%. And for more disclosure and information, is DRC is dollarized economy. So we have 96% of our total assets are in dollar. So that's mean that even revenue which are generated are in dollar terms. So that speaks as well on the split of the loan. The loan is actually at 98%, let's call it even 100%, disbursed in dollar, since the deposit as well are at 96% dominated by dollar. So this is the uniqueness of this economy, which is a dollarized economy. And with regard to the lending, so our key focus is to lend for SME, and with our strategic approach of supporting the ecosystem of corporate clients, so meaning the value chain of corporate, which is constituted by SME, and this is how we do focus our lending. Actually, there are some initiatives that we have launched to do digital lending for SME, which is completed. I think in the coming quarter you will see as well an increase on our SME lending. So we would say that our books is largely SME by 60%, and the corporate is reducing as well furthermore. Thank you.
Thank you very much. So Davis, the entire loan book is in dollars. It's split between corporate, SMEs, retail, and consumer. And because it's in dollars, it has no effect in terms of constant of currency. You also say you are noticing a decline in holding of government securities through OCI. What does this mean? And I will ask the chief strategist, maybe Brent, to respond to the question.
So the movements in our other comprehensive income is a function of how we hold our government bonds. Around 95% of our bond book is held as available for sale. So what that means from an accounting perspective is that the mark-to-market movements do not impact our profit and loss account, but it goes through the other comprehensive income and straight to our capital. So that movement you see is not realizations of us selling those bonds at a loss, but it just reflects the market conditions and how the bonds are fluctuating with changes in the yield. Thanks.
And maybe, Davis, that's where maybe you would appreciate the capital buffers of equity, because the mark-to-market losses equal to 16% have been netted off against our capital, and we are still 600 basis points above the capital minimum legal requirements. George, over to you.
Yes, this may go to Celeste and Dr. yourself. Now that DRC is so crucial to the health of equity, and by extension to the health of the Kenyan economy, give me enough comfort about the external regulatory environment, that is central bank, DRC regulatory framework, that can give me comfort that I'm sitting well and pretty. Number two, Daktari, between inflation and taxation, where do you feel, which one do you feel is a lot easier for the public policy people to deal with quickly enough to give us relief? Lastly, the El Nino phenomenon is with us, and it impacts agriculture more than anything else. Angela, what products do you have or ready or are you working on to give farmers relief in cases where they have had setbacks around environmental challenges, El Nino to be specific?
Celesta, do you want to go first?
Yeah, for the first question, as I said in my brief presentation, that the DRC is being supported usually by the IMF program, which is launching a lot of reforms, including in the regulatory space, banking regulation, which is bringing it to the level of Basel II or Basel III. So actually we are aligning with all the highest standard that the country should get. So this is one of the benefits we are getting from this program. There is quite a lot of reforms in all aspects, be it judicial or the banking regulations or other type of regulation. So I think in that regard, yeah, the country have made quite some significant progress. Thank you.
Achera, your insurance question.
Thank you very much, Dr. James. So thanks for asking about what we're currently doing. At the moment, we've not yet started distributing agriculture insurance. We are doing work around redesigning how it's done. As you know, it's currently index-based, which we believe might not be the best way. So we're currently doing the research around that to restructure how agriculture would be done. However, let me step back a little bit because insurance is always seen as after the fact, after the event has occurred. And usually protection is not usually just after the fact. There's usually risk mitigation that happens before. Currently, when you look at El Nino and weather patterns, I think my colleague Reshma had talked about the importance around climate. If you see the exacerbation of El Nino and the extent to which it's actually impacted, particularly the southern region, you will see it as an outcome of climate effects. A lot of the work that's being done by Equity Group, mentioned by my colleague Reshma in terms of capacitation, growth, knowledge of the ecosystems. I think my colleague Celesta had also talked about the Congo forest being the largest in terms of carbon credits. It's what we need to do as Africans to ensure that we can reverse the effects of climate change. Africa was a little bit late into the party when it comes to climate. I think not as industrialized as other continents. However, Africa does have the dividends that it would take to contribute or reduce the impact of climate change. So just to step back a little bit and look at it, not just from what insurance will do after the fact, which once we're ready will be coming back to you, but refocusing it really on the larger picture around climate and the work that Equity Group is doing around that.
There is a question from Edwin Wahome to asking about where are we with the acquisition of Koja Bank. He thought the long stop date was 30th September, and we have given that question to our Chief Legal Officer, who is leading us in that acquisition. Gertrude.
Thank you. Good morning, everyone. So as Edwin mentions, we were projecting to complete our Koja Bank acquisition at the end of September, but a key component of that was regulatory approvals that we required. As you would know, the transaction involved regulators from Kenya, our regulators from Rwanda, and the COMESA Competition Commission. Over the last few months, we've made significant progress with obtaining the regulatory approvals. We are now very close to the last stage. We are awaiting one key approval. Following that approval, we will be able to hopefully complete our pre-completion activities. We're targeting to complete the transaction on 30th November, which is a few days from now. We're optimistic that we'll be able to get to the target that we've set, and we will update the investors in due course. Thank you.
Thank you very much. The next question is about Equity Afya. And as I said, we recognized 40% of loan default occurs when a health incident afflicts a customer, and resources are devoted to dealing with the health incidents, and the cash flows are diverted from loan repayment. We felt we needed to provide then our customers with high quality, affordable, and accessible health, so that they could deal with that. And then we could make it very affordable using health insurance. But there was nobody who was providing mass health of the standard and the price we needed. So we formed Equity Afya franchise, offered it to our equity leadership program scholars who did medicine. We said we now have 102. As at September, we had 89 who were operational. They are seeing approximately 90,000 patients per month. And we have now come in to trigger the provision of health insurance, so that we make it extremely affordable, so that it is not out of pocket payments, but by our customers, but it's through policy. And I remember the last time we had a meeting, a customer, Catherine, challenged us, so we will extend the policies and Equity Afya to our shareholders too. So and generally the public will now take insurance, because we can separate it from bank customer. The bank will be willing to fund the insurance policy, so that it becomes very, very affordable. We pay to our once, and the customer can be paying a policy installments monthly or weekly, depending on how they want. But the question we have is, now that we have Equity Afya in all the counties, including the very remote ones, when will we see Equity hospitals? I have given this question to Dr. Joan, who leads us in this initiative. Dr. Joan has put a team, and maybe I will ask the team in health to go and start with Dr. Joan, and then she can introduce them. And as they move, Samson, Samora, Dennis, as Dr. Very good. As the doctors move to show our readiness now to deal with this, I want to draw the next few months. By June, we believe we will have 150 hospitals. We'll be seeing 300,000 patients. So it means then we'll have really normalized in the country and disrupted. It will be as inclusive as banking became. And the question is, that will give us power. Like when we dealt with COVID-19, remember, the board devoted $14 million, and what we said, we manufacture PPEs in the country, but we were not to set a factory. We used the purchasing power that we had to really get PPEs. And I want to draw the surgical mask. When we started, we were buying a single surgical mask for 800 shillings. By the time Equity was done with that sector, it was costing 2 shillings and 50 cents. The entire COVID suit was costing 20,000 shillings. By the time Equity had finished with the industry, it was only costing 650 shillings. So with the power of 300,000 patients, we can determine the inpatient policy in this country. And we can negotiate with hospitals that we will refer Equity Afya patients who require inpatients to their hospitals, but on terms and conditions that are suitable for affordable, high-quality health. So that might be the first option, but then chances are for very high specialized health, and Dr. Joan will talk about it, we can create centers of excellence, things like cancer, things like such that our people stop flying to India, because we will have brought the competence, the quality of US, of UK in the country. But over to Dr. Ali. I'm trying to overreach.
Thank you very much, Dr. Mwangi. And the question from Edwin Wahome is asking when we are going to see Equity Afya proceed into the level 5 and level 6 hospitals. As you're aware, and as has been mentioned, currently Equity Afya operates 102 medical centers. There were 89 as at the close of Q3 2023. We currently are attending to between 80 to 90,000 patients per month, which is very exciting. In addition to the fact as well that Equity Afya has expanded to every county of the country. So we'll be the first outpatient provider that will register presence in every corner of the country. So this expansion has been also very strategic. When we talk about even our progression into the inpatient levels of facilities, as we speak, the facilities that we run are all level 3A and 3B medical centers, which is the highest level of outpatients. Beyond that, of course, then we progress into the level 4, which are the inpatient primary level facilities, level 5, the secondary, and the level 6 are tertiary. So the question is asking us if that is in part of our growth plan, and we'd like to confirm that it is. But we will continue, I think, in our strategic expansion, because when Equity Group Foundation went into Equity Afya, it had 3 agendas or 3 things that it needed to address from the word go. So this was on the aspect of access, which we've updated that we've achieved so far, and we continue to progress. Once we get to all the counties, the next plan will be, what about the sub-counties? So on quality, we also have a very robust quality team that's monitoring the quality of services at Equity Afya, and we are convinced that you can match quality and affordability as well. So we have a team that's also looking into that. And the third agenda that the foundation was looking into when it went to Equity Afya was also the access, affordability, and quality aspects as mentioned. So we confirmed then that in future we'll be progressing into inpatients, again starting from the primary level, again inpatients, so focusing on the basic conditions which form a majority of the cases that we're seeing at outpatients, including management of the basic infectious conditions, as well as maternity, which we've seen even from our insurance partners account for currently more than 60% or around 60% of inpatient cases. So we'll continue to scale because we are fully committed to the aspect of access as far as healthcare goes. So as we've continued to expand as well, what we've also noted is that we need to strengthen our health offering across board, so that while Equity Afya is modeling on the service delivery front, there's also a lot that we can do together with our partners across the Equity Group. So the health sector of the bank is currently taking a huge focus as well in terms of what's the value offering for the health sector across the country. And we've grown the team, as you'll be able to see shortly, to be able to look at all those focus points as far as the broader health sector goes. So I'd like to introduce our colleagues who have joined. The team continues to grow as we also grow our infrastructure. We're also growing the human capital and capacity within health and then within Equity Afya as well. So I'll invite the teams to very quickly introduce themselves.
Thank you, Dr. Joan, and good morning, investors. Samson Mwangi is my name, team leader of Equity Afya. We are the providers of that solution to the customers that James spoke about, providing an all-inclusive solutions and health provision of our customers. Thank you.
You said you are managing director. Team lead, people don't understand what you are. And you can tell them where you have come from.
Thank you, James. I'm the managing director. I'm coming from Nairobi Hospital. where I was the head of finance director. And we are bringing that expertise to the group to ensure that we do serve our customers, realizing that the offering here is at a very different price point. We don't want to load the customers with the normal, usual health offering that has been or is the norm. So healthcare can be provided affordably, accessibly, and of the right quality. And that's the offering of Equity Afya. Thank you.
Thank you. Good morning, investors. My name is Samora Otieno. I'm a medical doctor with a background in international development. I joined with an extensive experience in NGO sector. I've worked with the British High Commission, where I was leading health for about 8 years. I was the chair of all the health donors in Kenya at some point, but most recently I've also come from the Nairobi County. So I'm currently the associate director in charge of the health pillar at the foundation. Thank you so much.
So affordability, we may bring the international community so that we see whether insurance policies can be subsidized by the international community, and we take away the responsibility of health provision away from them.
Yes, thank you, James. Thank you, Joan. Good morning, investors. My name is Dr. Dennis Ogola. I've joined as the Group Director for Health. I sit in the GCEO's office. My role is the coordination of strategic coordination of the health initiatives across the sector. I have a long history in private health sector. I spent my career at Avenue Group, which is a private healthcare provider that was running 3 hospitals and a number of outpatient clinics, as well as Evercare Group, which was a private equity-funded group that was a holding company across 4 hospital groups in the country. I'm really very excited to join the team in disrupting healthcare as we make it more affordable, provide quality and accessible across the entire region, not only in Kenya, but in the entire region. Thank you.
So Edwin Wahome, you have seen the man who could learn the inpatient hospitals and the experience he brings on the table, but chances are those hospitals will be franchisee hospitals.
Good morning. My name is Joseph Mwangi, joining the Equity Afya team as the GM Finance. My background is in healthcare financing, and I'm excited in providing my experience, which previously has been in the AR Healthcare Group, to further the promise of affordable healthcare. Thank you.
Good morning, investors. My name is Joseph Mbai. I have a pharmaceutical science background. I've worked in corporate pharmaceutical industry and also in government, in the county government. And I have joined Equity as general manager in charge of the health sector. And my experience will help the bank to onboard all the businesses that are in the health sector, right from the hospitals, the clinics, those who do imaging, laboratory, so that we grow the health sector and make it huge, and then bend ourselves as the bank that helps the health sector to give the best services. Thank you.
As Dr. Bai has said, we have not entered this for money. It's to really change health, make it affordable, accessible, and of a very high quality. So we'll also support all the hospitals under franchise, and we'll support others that wants to take the benefits. Like on Friday, we had 60 pharmaceutical companies from media in this room, and we wanted them to compete on manufacturing for us under contract, branded Equity Afya Medicine. And you can imagine what that would mean in terms of quality. But we'll be willing to give those medicine to any other hospital, because it's just about disrupting health and making it affordable for Kenyans and high quality. And that's why we had to establish our own franchise, so that we can demonstrate and you can ask. Last tray is to see, as you can see, all of them has come from health. We are not pretending bankers, we understand health. We understand strategy. of making things happen. So ours is to use the equity brand, the strategy, and get the medical doctors, headed by our chairman, Professor Masharia, who is an ENT surgeon, then to do what needs to be done under the brand. So Dr. Ogora and Dr. Joan will then supervise the health franchise. Dr. Joan?
Yeah, in addition as well, I think everyone is asking the question on gender balance. Of course, we have other colleagues who are part of the team. Dr. Sitonik has also joined as the General Manager for Clinical Services and Quality, coming in from AR Healthcare. And of course, we have Mercy, who's the Head of HR, Mercy Ngugi within Equity Afya. And lastly, the General Manager in charge of Business Development and Operations, who also joined us from Aga Khan. So we're committed to ensuring that we're able to deliver on health.
Dr. Mukuha, you should have also introduced her. So if you were going to Aga Khan, Dr. Mukuha is already here. So your doctor has moved. If you are moving to Nairobi Hospital, your controller has already moved. So feel free to consume the services of Equity Afya. Thank you. Anybody else with a question? Yeah. Give out the mic quickly. And there is another mic required at the back there.
Doctor, I'm here.
Oh, okay.
I'm here, doctor. Good morning, doctor.
Morning.
And your team.
Is your mic on? Put it closer.
Unasikia vizuri?
Yes.
I appreciate the work you are doing and your team, not you alone, and all the staff of Equity and all these subsidiaries. Let me first of all appreciate the DCR, the man from our DCRO. I think I was there. You saw me? And you gave me this hat for free. And I'm still having it. Thank you very much. Now, let us give a clap to our general, our MD from Congo. It was a very good chance that we went to Congo as investors, also as shareholders. What we saw and what we heard was very encouraging. You are growing up, I know. You have not reached on top, but you are doing it in a very good way. Now my question is, after that, our trip, how many branches have you again opened? Because we went through all your branches, and we saw your branches were in one room on 9th floor, is it? You are on 9th floor, 8th. Your office on 9th floor. Okay. We went to 9th floor, and we saw all your branches from MD was there. He's a Kenyan. He's your assistant. So that's one encouraged me that there can be no theft in the branches and ATMs when they are being monitored from one place. That was good. Second, you have got an insurance there. I think it's called Mayfair. That one was shown. Now this AFIA, has it taken place in DRC? This AFIA you are talking about, the AFIA insurance here, and the medical.
2 questions. How many branches do you have?
Yeah.
And have you established Equity Afya?
At the other side.
Yeah, in DRC.
Now, you did not talk about Goma, the fighting in Goma.
Okay, speak a little bit about Eastern Region.
Eastern
the last
region
question
of Goma.
The last question, Chami.
The last one is now you tell us when you will be ready for us to come to see you again and visit you as investors, as whatever, and everything. Thank you very much, Doctor. Asante.
Yeah, thank you for your visit, first of all. I mean, it was a pleasure.
I have to tell you my names. My names are Alois Chami.
Alois Chami.
Yeah.
Okay. Thank you, dear investor.
And you give me a card before you go, because I would like to talk to you when you are in this area. Thank you.
Yeah, thank you, dear shareholder. I mean, we appreciated that you came to visit us, and it was a pleasure welcoming you in DRC. So on the Equity Afia, I think the project have started. By the end of this year, we will be launching our first clinics already. So the construction work is being done. The medical doctor have been trained. So we are ready to launch Equity Afia in the DRC. And on the insurance, actually, we have signed the first step agreement with Angela. That was last week, where actually we are launching as well the bank insurance product already in the DRC. In the next week, we should be launching and making it operational. And on the instability of the eastern part of the DRC, I think that part have been quite a concern, but it's being handled by different government entities together with the Eastern Africa, plus the head of state have taken the leadership in solving this matter, and we hope as an investor and as a bank that this matter to be solved, and it will be great for peace and stability of the region and of our continent. This is what we will wish. Thank you.
So, Chami, 15 health clinics will be operational by December. We have hired 38 doctors. They are already working here in Kenya in our clinics, so in readiness of opening their clinics. And the last one is, while Eastern is a challenge, it's only the region with challenge is 1.5% of the country. So it's always good to say Eastern is not the entire Eastern. Eastern is the largest region, but what is affected is only 1.5%. It's very important, it's significant, but should not overshadow. So our branches, none of them are in Eastern region, from Kisangani to Bukavu to Goma, have ever been affected by that. Thank you. I thought I clarified. Thank you very much. Yeah. Thank you very much. The next question, yes. Raise your hand if you want a question. Yeah.
My name is Ochieng Olo, Think Business. Just bluntly, when will you be launching a health insurance cover? I ask because I think it will be a big game changer, not just for you as a group or the insurance subsidiary, but obviously to the rest of the country. Now, I feel you might be just a little late in launching your inpatient units. I don't know what model you're thinking about, because by the time you launch your health insurance cover, ideally, well, your idea is that the burden of paying credit has always been, shaken by medical issues. A lot of the cost is actually in inpatient treatment. So I don't know how this will gel. Just looking at that circle, how you want to handle that, I don't know how that will work in terms of getting, being effective. Two, let me just also point out that I haven't seen a lot of cross-selling or marketing. I would probably should have known about the it's called the last mile cover product that you have, the funeral plan that you have.
Last expense,
sorry. I have not seen anything. I have an account with the bank. I would have expected that probably you're selling across to your customers in the banking sector. Now, I think secondly, let me say that diversification, I think, has worked very well for you. And it is good that DRC is playing the role it is playing, and generally, actually, all your other subsidiaries. You haven't said anything about Ethiopia, a market that I think could also be a big game changer, yeah, and that you've stated previously that you're interested in. Now, in terms of your diversification into insurance, you've mentioned that there's a plan to launch in DRC. Hopefully, it is also in the other subsidiaries. But I'd want to find out from Angela also, what is a plan in terms of rolling out in those regions? And more specifically, we've talked about the economic downturn in Kenya and what it is causing the bank, the Kenyan unit, in terms of performance. But what sort of impact have we seen in the insurance sector? Has there been some impact because of the economic downturn that we are realizing at the moment? And that is it.
Thank you very much. Let me answer the simple answer, and I leave Ajara with the last one. Insurance effect. Equity Afia, when is the health insurance? Broadly, remember, this was an area we had to be very, very cautious because we added our blood to a very delicate sector, health. And so while we were working things out, we were cautious that bankers don't do anything. And maybe that's why you find the equity Afia insurance had not been launched. Now, the team we wanted has all boarded. I think in the last 2 months, that's when they have all taken up their jobs, because we wanted them to do it professionally, because we wanted to maintain relationships and professional relationships with where they were coming. Although it's the right thing to do, we do things professionally. So we were waiting for them to come and be the face of health. The only person we had was Dr. Joan, and we didn't want Dr. Joan to start until... So the second thing is impatient. Yeah, we are late. Yes, we are late, but we wanted to do one thing at a time. We realized impatience is about 3% of health needs. 97% is outpatient. Those are the queues you see from health centers all the way to referral hospitals, people who don't need. So if we used the 2080 rules, just first of all deal with the 97, it's easy. We can be everywhere in the country suddenly, and we dealt with that. The second aspect of impatient is it can equally be fast, because we can roll it through franchise. Just get the people who are willing to pay by the rules. Rules is quality, affordability, and accessibility. So we can own 100 hospitals very easily. The way we don't own the Equity Afia clinics. They are owned by individual doctors. What we did was to fund them, but under very tight franchise. And you can see the people supervising the franchise. So we can easily get that. And as Dr. Johan said, again, when we looked at inpatient, 80% is simple inpatient needs. I think we saw 35% of it is pregnancy, is delivery. It's 60% of it is delivery. So it is not really inpatient sickness, is convenience for delivery, doing delivery the right way. So again, that's what she said. That doesn't really require anything above level 4, because it's just, so again, we'll deal with that very, very easily, and it may mean hospitals of 12 beds throughout the country. You deal with 60% of inpatient. Then waterborne diseases, take another. So again, so the 10% is where we may need to do. The rest we can do through partnerships. Yes, we have not advertised, as we said. We wanted to perfect the model, and we felt we needed to perfect the model without going public. And we have really perfected, that's why the performance. So you'll be seeing us scaling up advertising, promoting from maybe next year. In terms of Ethiopia, and sorry, you also talked about health insurance. We needed to be sure that we do it specific. So we needed to form 3 insurance companies. So far we have formed 2. The third one is so that they are completely branded for what they do. they become specialized, like the way we have a bank license, we have an insurance license, we have an investment bank license, an MVNO license, a PSP license, and a dedicated entity, so that we really change the industry. So bear with us, better late than never, but when we come, as you see, it will be complete transformation of the industry. Ajira, what has been the effect of the macroeconomic shock to the insurance industry?
All right, thank you, Olo, for that question. I'll start with the impact on insurers. So as you well know, we have life insurers and we also have general or health or short-term insurers. Our short-term insurers would largely be holding a larger portion of their assets in shorter term securities, and as such would not be affected by mark-to-market largely or increase in interest rates. But life insurance companies, particularly those who have a high exposure in the longer term bonds, this is historical or legacy books, have definitely seen the impact of mark-to-market, particularly the increase in interest rates. Also, if you look at some of the larger insurance companies who have holdings in real estate portfolios, starting to see some strain around particularly the investment performance of their portfolios. So a larger proportion you would see definitely on the life insurance side, much less on the general insurance side. The other thing, although I would mention from an insurance perspective internally, is this year is the first year globally for us to report under IFRS 17 requirements. IFRS 17 basically means that we are required as insurers to recognize losses upfront, and we are also required to delay the recognition of income, which has not been the case. So again, in a tough economic environment, we expect IFRS 17 to create more pressure in terms of the performance of insurance companies. In Q1 of this year, only 4 insurance companies in Kenya were profitable, and we expect that by the end of this year, with the application of more stringent rules on revenue recognition, that you will start to see that coming out of the wash in terms of, let's say, not as favorable performance towards the end of this year. The last one I'll mention is with respect to underwriting. Now, historically, insurers were underwriting based on internal rules. However, last year, the reinsurers, particularly in East Africa, introduced minimum underwriting rates. The effect of the minimum underwriting rates, particularly for portfolios that were not performing well, these are called listed risks, where the loss ratio was above 65%, the reinsurers then introduced a minimum rate of 5.5%. This would then mean that in the last 2 years, you would have an increase in terms of the cost of insurance shilling for shilling. 2 things have then happened, particularly in an environment such as this, is because of lower disposable income, even for companies or MSMEs, you'll find a lot of organizations walking away from insurance covers that are not mandatory, because definitely the cost of insurance has increased. We've also seen situations where insurers are now partnering with each other or syndicating risks, particularly where you might find pricing from the reinsurer takes you beyond what the customer may afford. The last one, although I would mention this is from a consumer or retail perspective, is that currently in this environment, much as it's a difficult macroeconomic environment, you will find that at the moment a lot of customers are having access to the higher yielding government bonds, even in the retail sector. Now, on the banking side, it's very evident because you'll see a flight of deposits where customers would be withdrawing money to invest in government bills. However, you'll find that it's very slow. The impact on life insurance or savings products would be quite slow, particularly because most insurance contracts are long-term in nature, and second, withdrawals would typically have some penalties or exclusions. So again, not as bad as we saw 2 years ago, some slight impact where customers, when their policies come due, would rather renew or take them and buy the higher yielding bond. But in terms of lack of persistency, in terms of cashing in current covers, that is not yet something that we would see. But when it comes to rollover, customers will choose to go for the higher short-term interest rate, just looking at what is competing for their capital at the moment.
Jera, maybe uptake of policies, is it as robust as before the macroeconomic policy?
No, actually, that's a good point, Dr. James. The uptake actually has been affected by two things. One, when you have consumers having lower disposable income, and I think it's important I mention this, currently insurance is seen as a luxury. When you look at how we spend our money, generally, consumers don't think insurance is a must-have. They think it's a good to have. And as such, when there's pressure on disposable income, it then means that money spent on insurance covers would be one of the places that customers would forfeit in terms of day-to-day spending. So we have seen a lower uptake in terms of insurance covers, but we also believe that, as Dr. James mentioned, one of the challenges that consumers have is affordability of insurance covers. So on our side, in partnership with the bank, for instance, Equity Bank Kenya Gerald's team, we are able to still provide liquidity for the customer to pay for the insurance cover upfront so that they secure the cover that they need, and then through insurance premium financing, enable them to have a partnership with the bank where they can then pay back the cost of premium as and when they get their cash flows. And because it's a customer who's known to Equity, their cash flows are known, it's much, much easier for them to get insurance premium financing than it would be from a different arrangement.
But we have seen a decline in borrowing, so it means also credit drive will also be declining in the insurance company. There was a question on that side before we come to the ready. There, please, and then we come to the ready, and then in the middle, yeah, please.
Right, my name is Ronnie from AIB Axis. I have two questions to Mary. Firstly, I noticed the 32% growth in interest income from loans and advances to 70 billion. Kindly break down the contribution, like how much of this is actual volume vis-a-vis how much of this is attributed to repricing under the risk-based pricing model. And secondly, picking up that your strategy now is geared towards working capital lending, which has the effect of lowering your average duration. Does this, in your view, raise the refinancing risk once interest rates begin to decline? And if so, how do you plan to deal with it? My last question goes to Angela. In line with the IFRS 17, if you're able to contrast for us the current contract service margin for the general business vis-a-vis the long-term business. Thank you.
May I ask, because it's on risk, so that you can answer them together?
Perfect.
Yeah, my name is Esther Otieno, and in your presentation, you talked about translation. I don't know if you are talking about translation exposure, because considering that translation exposure affects the tangible assets of the company. And another question was on you talked about managing the risks. So asking is, how do you measure your risks and how do you mitigate them, if you mitigate? And I've realized that on your foreign exchange risk, you are greatly cushioned. I presume that you are greatly cushioned by DRC. Thank you.
Thank you. So Sam, you can take the podium.
My name is Esther Otieno.
Esther's question, Sam, you can take the podium. Mary, you have been asked. But let me, first of all, state, as we said, our yields on loans have not gone up. So it's not a factor of pricing. Loans have gone up by 26%. Interest has gone up by 28%. So there is no pre-pricing. As we said, we chose to cushion the customer other than interest. And that is why, while interest expense went up by 58, because the liability side repriced, but we didn't reprice the asset side, because we chose to observe that differential so that we maintain the quality of the loan book and to maintain the health of the businesses of our customer, particularly micro, small, and medium enterprises. What was to kill them this time is inflation, it's interest rates, is exchange rate. So we thought, why don't we cushion them? And that's why we said earlier on, we chose the customer over profitability. But Mary, you can give the numbers.
Actually, that is how I'd cover it. But just for mathematics purposes, we've repriced maybe about 65% of the loan book in Kenya. The repricing moved from about 13% to an average now of 16.5%. So you can work that out based on, position of the book as at December. Look at the 9-year position and look at the differential. That would give you how much would be the differential between growth and repricing. However, the repricing may not be as significant as James has noted because of the mechanisms that we've used to support the customers. Maybe I can address the second question on refinancing risk as well.
And maybe also add there, remember, we are maintaining customers at 16 when the sovereign risk on boards for a similar period is at 18. So it's a deliberate, conscious decision not to destroy businesses' interest rate because then we will suffer default. So the sovereign risk seems to be higher than microfinance risk pricing. That's why I said we chose deliberately because we didn't want to deal with mass default.
On the short-term nature of the strategy now in terms of our lending, does that result in a refinancing risk? Yes, there's a risk that customers do bring in a lot more velocity. But if the interest rate regime comes down, that means the pricing as well of loans does come down. The affordability becomes better. What means for us as equity is we grow volume. So while the interest rate may come down, we are able to incorporate a lot more of the private sector into this borrowing, and we're able to grow that economy, grow the book, and therefore you would not see an impact on interest because there would be a compensating factor of volume where the interest has come down. Yeah.
Profit is a function of P and Q. Very good, Sam. The question.
Thank you for the question. We use various tools to measure risk depending on the specific risk type. In equity, we have 16 principal risk types, financial and non-financial. So in terms of the tools we use for financial risks, take credit as an example, we use scorecards. And Mary has spoken to the repayment rates that we are getting on our short-term digital credit as a result of the scorecards that we have deployed. We are implementing better credit rating models for our corporate and other segments. For market risk, we've spoken to mark-to-market measures and the impact it's having on capital. So that's a measure that we track. We track net open positions. This is a regulatory ratio and a number of others for market risk. Even on the non-financial risk side, there are measures we have deployed, such as for each of our customers, rating them from a financial crime risk perspective, anti-money laundering and countering terrorism financing. So customer risk assessment, which is a regulatory requirement, we rate our products, our product risk assessment, we rate country risk, and so on and so forth. So depending on the specific risk type, there is a measurement tool that we deploy. Thank you.
And maybe on risk, we have 3 levels. There is level 1, which is, Wafura is in the house? Maybe you could start. That is our group director for the level 1. Do you want to say a couple of words about you? Give him the mic.
Thank you, Dr. James, and good morning, investors. Yeah, so I look after the first line of defense, which is internal control and compliance. What we basically do is support the first line to identify and mitigate risk. Yeah, and
so that is the man of procedures. He does all the procedures, he checks, he does the template. we manage risk by running the bank through policies and procedures. Then the second line of defense come in, headed by Sam, and that is the compliance. Is Wafula complying with the policies, with the procedures that he agreed on? So once he's satisfied that the policies are being complied with, the procedures and processes are being complied with, then the question is adequacy of those policies. So he's in charge of policy. We call that the second line. Then there is the third line of defense, which is Fuamba. Fuamba is in the room, Chief Internal Auditor. Then his is statutory, and he does it on behalf of the board. So it is really oversight. Then there is a fourth line of defense, which we call the governance. Is the governance structure working? And there we have a dedicated executive director, Mero Amai, just ensuring we comply with all the governance policies. That's, Mary, do you want to say one or two things about level 4? What governance risk management means? Briefly.
Yes, thank you. Thank you, James, and good morning, everyone. Thanks for coming and tuning in. It's really taking care of especially the new trends and the new developments in the industry. Because as you are aware, every day we are being confronted by new changes to the regulations, the statutes. We are now embracing newer regulators as we expand our jurisdictions. We have insurance now. We have new territories, DRC and the others, in addition to what we are used to before. So it is important for us to always keep on reviewing what are the requirements of governance and make sure that we are always within the requirements of the law. And also we are observing the new governance requirements. You'll also remember that ESG has become a very critical part of our business. So we are now studying and seeing, are we in full compliance? Are we carrying our customers along? Are we carrying everybody along, our partners and everybody else? So we will ensure that that happens, and we'll always be on the right side as the changes happen. Thank you very much.
And that is where authority, maker, checker, authorizer structure is. So what is the distribution of power? What is the structure of governance, and how is authority vested, and how is our oversight of use of that authority? She has talked about ESG. That to us is the biggest risk going forward. Leshma, do you want to say what risk you manage? Yeah, you can go, it's easier.
So from an ESG perspective, and we also call this sustainability, we look at 3 key elements, the environmental aspects of it, and also the social aspects, and then the governing aspects of the environmental and social. But when we look at the environmental and social aspects, there are different layers that we need to look at. Number one, what affects our clients? And when we say what affects our clients with these ones, is what impacts their businesses and affects the resilience of their businesses, but also how it affects them in terms of their ability to repay any facilities or loans. So we look at it from both perspectives, the risk to the bank, but also the risk to the client, so that we can provide a value addition there. We also look at our own operations and what are we doing around minimizing our own environmental and social footprint as well. And we are also now beginning to look at our suppliers who provide services to us. So as much as they are environmental, social, and governance, we also have layers within that that we look at. Holistically, that provides a complete picture in terms of what is our impact as us, equity, but what is also the impact of the activities that we are supporting through the financing aspects as well.
That's a delicate balance between people, profit, and planet, just to be sure that there is a future because we took care of nature. So how much are we focused on nature? George, you had a question that was never answered. Question 3, was it about risk and treasury?
Between the threats from inflation and taxation, which one where do you think we can get faster and easier, faster relief from maybe public policy, policy regulation?
Lydia Dilango, where are you? Very good. Do you want to answer the question? This is a group director for taxation. You have understood George's question completely.
Yes, he's looking at it. Where will we get the relief from the policy perspective or increase in taxes, right? So what you'll see, and from the media reports, when there was an increase in taxation, especially for the fuel, but what happened is that the government didn't meet their targets, even with the increase in taxes. And this is because the spending power has been reduced. And what it actually calls for is that people are asking for, give us the service vis-a-vis the increased taxes. And what you'll see, even if, based on the theory, even if you increase the taxes to a certain extent, you will still not collect it because the spending power has dramatically increased. And you'll see that even if now the tax has gone all the way to 36.5 for people in employment, the collection has still dwindled because what has happened is that people have to let go others so that they can accommodate the few people that they have within their companies. Thank you.
So, George, is a very delicate balance between cause and effect. That delicate balance on policy, and that's why they call it reforms. You need to clearly reform until you get the equilibrium point, which we don't know what is the equilibrium point.
Good morning, everyone. My name is Sally Chepkorir, and I have 2 questions. But before, are you men? Are men in the house? I want to wish you the best and congratulations for Men's International Day that was celebrated yesterday. I want in a special way celebrate you today. And now I want to go straight to my question now. My first question will go to Celestine, the MD, Congo. What assurance are you giving us now that the general elections is taking place in Congo, that the business is not going to be affected? Number 2, question 2, goes to the MD, Kenya, and the CEO, and the Vice Chancellor, or the Chancellor, Virtual University of Kenya, Dr. James Mwangi. What role does the company play in entrenching sustainability in the business going forward? Thank you.
Thank you very much. Let me try first, but there is an MD of Kenya. He's very busy writing because he thought it is question. Give him the mic, George, Gerald, so that...
Thank you very much, our dear shareholder, and thank you very much for wishing us Happy International Men's Day. Thank you. In terms of Kenya, what is it that we are doing for sustainability? There are quite a number of initiatives that we are doing. One is in terms of diversification. We are diversifying. Looking at our customer, we are now an inclusive bank. So we take care of the micro, the retail, the SME, and the large enterprises. So that diversification, again, it is also supported by the sectors. We are all over in the sectors. When it comes to agriculture, we are a big player. When it comes to other sectors like maybe even in trade, we are also big players, customers who are doing trade, regional trade and also international trade. We are also big players there. So what we are praying aloud, or what we are acting on, is to ensure that there is that diversification, so that if one sector is affected or if one segment is affected, the all combination or consolidation of all the segment and the sectors comes in place to play the issue of sustainability. Thank you.
Celestin, can you give assurance?
No, I thank you. Thank you for the question. And yeah, for me, it's about mentioning that there is more and more consolidation of democracy in the Congo. So this is a fact. Looking at the different elections which took place, and the more we are advancing, I mean, it's smooth. It's going with peace compared to the last experience. Compared to this one, I mean, we could see a big improvement in terms of inclusivity, in terms of even atmosphere. I would say that the campaign, the electoral campaign, will be only 1 month, though that shows there is an intent of no creating any disruption, because business are as usual. I think for those who visited DRC 2 weeks ago, they could feel, oh, there is no actually campaign, or you know what is going on here. So actually it shows a kind of maturity, and we wish that the election take place well, and the winner wins, and everything goes back to normal. So I think there is no indication of concern so far. Thank you.
I think let me just add my voice. I was in DRC last week, and I was really surprised by the focus of the country in economic issues. You could be surprised. For us, we are already talking about 2027. Last week, they were not talking about December 20th, which was it's 10 days, it's 30 days from today. So the second thing I was shocked is how inclusive that election is. Whoever wanted to be president is on the ballot, 26 people. So you can see the openness and the transparency with which it was done. And it was not a big issue. And you got so, and the last three, I didn't feel any shade of tension whatsoever in DRC. And even ourselves, when we tried to map how we to deal with it, it is not appearing on the risk mapping, the heat map. You don't see heat. So it looks like we wish them well. You can't guarantee, you can't assure, but all indicators, this might be the smoothest election DRC has ever gone through. And I guess that's why Celestin is constantly using the word consolidating democracy. They are seeing the fruits of democracy. But let me add on the question of sustainability. If you remember, the world sat down in 1945 because of Hiroshima. It was a nuclear bomb that had been dropped, and the world, for the first time, saw the existential threat of the head of the world. And then they sat down and said, no, let's create institutions that could guarantee peace and that there would never be another world war. 75 years later, we have not had a world war because the structure of governance were created. Looking today, we are in such a juncture again. With continued global warming, if we sustain the carbon emission, the rise of temperatures will make the world unsustainable. If you look at the issue of droughts, the issue of floods, the issue, they are all speaking about a world that has reached a point that the survival of the world as we know it is at risk. To some people, there is an existential threat. The melting of the glaciers, again, a huge risk, wiping most of the island countries, the small island countries. And so the world has woken up to the reality that this is an existential threat and has chosen to address it. We felt, given our leadership position in Africa, we would rise to the occasion and put the agenda of Africa on the map. I'm glad to say I was honored to be asked to be the co-chair of the UN African Business Leaders Alliance for Africa, to bring the entire entrepreneurial business class together to address that issue. And that eventually led us to say, let's put the private sector. Let's not leave this thing to government. The government has no life, but the private sector leads businesses, leads people. And we mobilized and brought the entire African private sector to have its voice. And I was very privileged to lead the statement of the private sector during the Africa Climate Summit in Nairobi, and hand over our note. Since then, we have seen that take us through to UN and push the UN agenda, and we have pushed that, and we are headed to COP 28 next week to present. But what has been most exciting is to see the Kenya government formulate a strategy for green industrialization, and I've again been honored by His Excellency the President to be incorporated as an advisor. So we can see we have, as Leshma pushes the agenda internally, so with the support of her to understand the technical aspect, Joy here has made sure that we're able to present the case of Africa. Uniquely, the Africa has been very well positioned, and maybe as the world deals with the issue of this existential threat, it can't do without Africa. And Africa is the provider of 60% of all potential sustainable renewable energy. So if that were to be developed, then it may mean the transformation of the entire African continent. As Celestin said, the mineral resources that are required for the technologies used in renewable, sustainable energy, the bulk of them are in Africa. For instance, cobalt, 70% of world reserves is in DRC. When it comes to lithium, DRC has what percentage? 40% of world lithium. When you go to manganese, it's about how much? And the 3 Ts?
For the 3 Ts, it's above 60%.
What are the 3 Ts?
The 3 Ts are...
Brent, you can jump in. You are not so sure. Name them, I will help.
I don't know, I'm getting
yeah,
the name.
Give Joy a mic.
Yeah, tin and tantalum. So
as we can see, another 60%.
Tin, titanium, yeah.
Yeah, in DRC. So essentially what we are saying, if the world is to resolve and avoid this existential threat, if we position ourselves as Africa, then we'll be lifted. We'll use the strategic green minerals as a catalyst of transforming Africa. We use the renewable clean energy as a mechanism of transforming Africa and making Africa very attractive for foreign direct investment. And it's on that basis that we created the African Recovery and Resilience Plan. If you look at the title, Recovery, it's nature and environment recovering so that we deal with climate change and how we do things, how we do agriculture, how we do mining, how we do our SMEs. And essentially, we have rallied these around the world. we have managed to get attention of about 16 development banks to sign it up, the Bretton Woods institutions, the UN agencies in the region we operate in, and we have got also the attention of the US government, the UAE government, and on the plenary, this COP28, the African Recovery and Resilience Plan will be on the main stage, and it's African development based on the role Africa can play on climate change. So we see us playing role not just at the micro, macro, global level, and shaping the narrative and positioning Africa. We are very lucky that when we had already done this, we got the political leadership of President Ruto, and the fact that he has invited us to partner, then it means that we can take that agenda from African political leadership and African private sector and private business networks. And hopefully we should be able to see massive investment in the continent on clean businesses. And maybe Africa will be the first continent to industrialize green without emissions. Looks like that, oh, sorry, there is one more question there and another one there. Sure. Very good.
Morning, my name is Bella from Bloomberg News. I'd like to get your comments on a recent directive by the regulator in the DRC as concerns the shareholding of entities like yourselves there. And it's given a timeline for 3 years or for this directive to be met as concerns the shareholding there. I'm curious to hear what are your views, what are your concerns, and what are the opportunities from this directive. Thank you.
Thank you very much. I think for those who have not seen the regulation, is a bank in DRC must be owned by at least 4 shareholders. The good thing, Equity DRC is owned by a publicly listed company. So it is owned by 32,000 shareholders. Because when you look at the same regulation, it is asking for beneficial ownership. Who is the beneficial ownership? And the beneficial ownership of DRC is the 32,000 shareholders. So we are in full compliance. The second question there. Oh, sorry, a follow-up question. Come again?
It talks about 16 unrelated shareholders. Is that?
That's what we are saying. Okay. We have that 2,000 unrelated shareholders. Because when you look at the regulation and you look them together, it is not necessarily who is holding the share certificate, who is the ultimate beneficial owner. So ours are unrelated 32,000 shareholders, and that is the law globally. So it is just a clarification that when you are a publicly listed company, you can be the single shareholder because you represent the ultimate shareholders. And so we are in compliance of that stipulation. This, the last question.
Herald Allo from People Daily. You mentioned that DRC is expected to grow bigger than the Kenyan market, I think in 2030. Given the growth we've seen in that in the DRC market, I don't know whether you're expecting this to happen sooner. And also on the same note, I don't know whether it's the DRC that's sort of cushioning you from the FX hits you're experiencing in Kenyan market. Then the second question is, your subsidiaries' profit contribution, the projections have been changed. I don't know what's the DRC proportion, or just how do you see the outlook in terms of profitability in the near term. And then lastly, your profit in Kenya, I saw it dipped. Maybe if you can just give us, what do you attribute to this? We know we've been told there are sort of external shocks and all that, but still your other subsidiaries outpaced Kenya. Maybe your comment around that.
Thank you very much. If you look at the entire region, when we operate in 6 countries, Kenya, Uganda, Rwanda, Tanzania, DRC, and South Sudan, the country that has really had the biggest impact of the global macro shock is Kenya. It's the country whose currency have had the most significant devaluation. Our currency has moved from 116 to what it is today, 157. If you look at that, that is approximately a 23-24% depreciation of the currency. And that has carried the biggest impact because then it has translated into imported inflation. Imported inflation, at a time, the country had to import food. At a time, a country then had to import energy as we know it. But also, while that required a lot of dollars, on the other hand, it is when US and the developed world increased their interest rates and became more attractive than emerging markets. So when our demand for currency to import food, to cater for the devaluation of the Kenya shillings, at the same time there was massive outflow reflected by what happened to the stock exchange, because that is the most investments that foreigners had invested in, a massive outflow. So that made the situation in Kenya quite challenging. As a result, Kenya has experienced sluggish growth than any other of the market. The fastest growing markets are Tanzania, Rwanda, Uganda, and DRC. DRC is so visible because it's a big subsidiary. It's 60% of Kenya. The others may be 20%. So even if they grow at the same rate like DRC, in absolute terms, the quantum is lower. But this speaks to long strategic thinking. And then this really validates that Equity has been very strong in strategic thinking. There's never been a gap in start of strategic thinking. And you remember the arguments we have had in this room. Why are you deploying capital in low-earning markets like DRC, while we have a high growth and high return in Kenya? Now, the reverse has really happened. If you look, DRC, Rwanda, Uganda almost have all overtaken Kenya in both return on equity and growth rate. And these then have helped the group. If you look at Kenya, Kenya is down, I think, 25%, if I'm not mistaken, in terms of profit. But it has been overcompensated by growth of profit in Uganda, Tanzania, DRC, and Rwanda. And as a result, we have registered a 5% growth rate. Now, because Kenya is the most integrated globally and most diversified, when the tide turns, the first country to lift again will be Kenya, because it received the biggest thing. And as we said, we think inflation and interest rates have peaked, so it's a question of when do we start seeing. This week, with almost an affirmation for the third time of interest rates, and the Fed not adjusting, we have started seeing movement now towards stock. So it's a question, when will be the global capital come back? If you look at Latin America, it has flown in easily, so we expect that to then start reversing in Kenya. I think last week we saw significant recovery of the stocks, that the two big stocks that had received the biggest hit. They showed the signs of starting to the journey of coming back, and that is the best indicator. We also saw the oversubscription on the infrastructure board that was issued by the government. The government was struggling to meet on over what has been subscribed. So that trend seems to be going in the right direction. Then we said because Kenya was the most affected by microshock, simply because of exchange rate, particularly the depreciation of the Kenya shilling, the inflation, we chose to depress interest rates and also not to pass our operational cost. We said despite interest rates on our deposits or cost of funds going up by 35%, if you look at the yields on earning assets, they only went up by 7%. So that explains interest expense growing by 58%, while interest income is growing at 32%, creating a net interest of 28. So again, you can see, then you'll also see when it came to expenses, because of inflation, because of interest rate being factored, our operating costs went up, I think, by 47%, again, much higher. But as you can see, we have used the P&L to cushion the customers, but we know that's a one-off, and we were fairly well compensated by the growth in the subsidiaries that had been affected. We expect the fastest growing subsidiary going forward again will be Kenya as it bounces back. The good thing, we said the balance sheet of Kenya is intact. It is highly capitalized, 600 basis point above legal minimum, so it can really grow substantially, that balance sheet. It's a liquid balance sheet with 49.7% liquidity. So it's very agile, it's very, very flexible. And when you look at the quality of its loan book, yes, it's the one that has received the biggest distress, but it's a secured loan book. And beyond being secured, it has guarantees of 21.4 billion, and it also covered by provisions 67%, meaning that the P&L of next year is not at threat. And lastly, we have seen like NPLs have peaked, and we expect hopefully to see them starting to decline even on the fourth quarter. So we are very optimistic about Kenya. I hope I have too much data, but I hope that put together helps to explain. I want to thank all of you for a very engaging and very interesting conversation. You kept it alive with your questions, and my colleagues kept it alive by answering the questions. And you can see, and I am grateful for those questions, because it demonstrates the quality of leadership and management. None of them was prompted of the question before the question came, and all the answers I felt very, very proud of them. I was particularly excited about the interest of the investors about health and insurance, because the two will combine maybe to transform the health and insurance industry as we know it. The role that equity played in the financial sector, democratizing finance, I'm seeing health and insurance being democratized. The reason why we believe insurance will do better is because South Africa is at 14.5% of GDP, and Kenya we are around 2. So you can see Kenya can grow its insurance 7 times before it reaches where South Africa is. And that headroom, if you then do it right, like Ajara has said, all indications is that equity has got it right, then we will be up for a big, if insurance grows 7 times, and Equity keeps, like we kept the larger portion of that market that is unlocked, undoubtedly, Ajara, you should be leading the largest insurance group in by 2025? 2 or 3 years?
2030, James.
Of course, under promise and over deliver. So Ajara's target is to be leading the largest insurance company in Kenya by 2025. We don't know about 2030, but broadly, those are all indication that it is. In just 9 months, you moved, there are about 56 insurance companies. You are number what? 11. And this year you are closing at number what? 5 in balance sheet and profitability? Number 4. So why would we wait? If we have moved in 9 months from number 56 to number 3, number 4, why would we wait until 2030 to be number 1? Maybe you don't need 2025. You might do it by 2024.
Challenge taken, James.
Challenge taken. So, and then we are size. I think it is the most exciting is health, and Dr. John, we are very grateful because health, insurance is an intermediary. You will not be able to get a great health insurance if the supply is not high quality and affordable and accessible. And Equity Afia solves the problem. Also, as we insure our goods, we insure our health, and we insure our lives. And the fact that we are a 19 million customer bank, if every customer who takes a loan takes an insurance, then Nigeria should be the largest insurance company by 2024, not even 25, because it's bundling products, it's cross-selling, and the same customer who needs the product need a bundled customer. We thank you for this beautiful conversation. For the media, we are very grateful of your patience. We started at 8, it's 11. What an incredible cover. Let's put our hands together for the 4th estate. Thank you very much and have a blessed day. I am told breakfast resumes. Alex, over to you.
Thank you, James. As we come to the end, the investor booklet, the press release, is available for our friends from the 4th estate and the analysts. As you leave, kindly pick a copy. And the same has also been uploaded on our website, both the investor booklet, the financials, and the press release. And once again, thank you. I want to invite Bishop to close for us with a word of prayer, and then we'll do the equity anthem. And like Dr. Mwangi has said, breakfast will be open. Thank you for coming, and God bless you, Bishop.
Thank you, Alex. Let us pray. Father, we thank you once again as we come to the end of our investors briefing today. We thank you for such a wonderful meeting that we have had. And more importantly, we want to thank you for the figures and the results that we were able to register in that challenging time. We thank you because we have never failed, because you have always stood with us. And we acknowledge your help, because some things happen because of the divine intervention, which we acknowledge, and we are so grateful. As we thank you for what we have already done, Lord, we remember that there is a future, and we are ongoing. How we pray as we put our trust in you, that you will help us to penetrate the markets in the different areas the Lord you have helped us to venture in. May you give us victory, and we shall be careful to always bless you and give you thanks. We want to pray for this year 2023, that as we continue and prepare to close the year, that in the remaining period, dear Lord, may you open the doors for us. Help Equity Group that we may soar and even get our expectations and even more because of your grace. We know with you we are a winning team. We have always seen that in the past. How we pray that this year we shall have a reason to glorify your name because of crowning our efforts with success and wonderful results. We thank you for all the investors. We thank you for all the shareholders. We thank you for the staff. And we thank you, Lord, for all our customers. How we pray that you continue blessing them, expanding them and expanding their territories. We thank you even for the nations where we are operating. How we pray that they continue enjoying prevailing peace. We thank you, Lord, and we bless you. Even as we part, may your peace and your grace be upon us. For this we pray in your holy and precious name. Amen.
Let's kindly be upstanding for
Don't I obey?